oversight over our nation's largest banks and their activities. Last year, 4 of these mega banks testified before us. Since then, our nation continues to battle an ongoing epidemic, inflation, that's affecting every household's budget, Russia's invasion of Ukraine, rising interest rates, and other crises that have battered our economy. In this environment, the role that banks play to protect consumers and provide access to affordable credit is absolutely critical. Over the past several years, we've seen the system of banking in this country take a dramatic shift. Our nation's largest banks have gotten even bigger during the pandemic, in part through mergers. Regulators have rubber-stamped these merger applications for far too long, and it's past time we get to the bottom of who these mergers are actually benefiting. For starters, I remain concerned that branch closures across the country, which are often a consequence of mergers, are expanding banking deserts and harming communities that rely on branches for basic banking services. The committee will also examine banks' commitments to underserved communities as our nation's racial wealth gap widens and Black applicants and others continue to be discriminated against. I'm eager to hear about their efforts to ensure communities of color finally get fair opportunities to build generational wealth. The CEOs will be asked for an update on the diversity and inclusion commitments they made following the murder of George Floyd and details on additional measures they will take. In addition, following news that Equifax sent inaccurate credit scores to lenders, who in turn use them to charge consumers higher interest rates or even deny them credit, I'd like to hear what these banks are doing to ensure their harmed customers are identified and promptly made whole. As the compensation for these CEOs go up dramatically when compared to their tailors and other customer-facing employees, many of the banks they represent have simultaneously earned the title repeat offenders for their continued violations of the law. The committee has received a long list of unlawful actions resulting in fines, but these fines pale in comparison to the billions in profits these banks make and amount to nothing more than another cost of doing business. So I'd like to hear how these banks are working to update their compliance practices and commit to following the law. There are many other issues the committee will explore today, including the rise of emerging technologies. Many consumers have reported being scammed through money transfer apps like Zelle, and all the banks before us shrug their shoulders. We also want to know what these banks are doing to protect their employees following the Supreme Court's shameful decision to abolish Roe versus Wade, along with efforts to combat gun violence and much more. So I look forward to hearing testimony from our witness today, and I yield back. I now recognize the ranking member for 5 minutes.
Thank you, Madam Chair. And frankly, I disagree with the premise of this hearing. It's not because I disagree with holding folks accountable. Actually, rather, that's the opposite. In fact, I think this committee has done woefully little over the past few years to hold agencies and those industries we oversee accountable. I disagree with this hearing because it's theater, not oversight. The majority has had 2 years to do its job of oversight, and they've failed miserably. Now that we're just over a month away from the midterms, they're posturing. Democrats first held this hearing back in 2019 in search of a headline. And when they failed to garner the positive press they were seeking, Democrats felt emboldened by the Biden administration and their one-party rule of Washington to drag the CEOs back in 2022, demanded they parrot their progressive agenda. Now, 1 year later, we expect more of the same, this time at the expense of focusing on the real issues the American people are facing. And when it comes to the financial system, the list of issues is long. We're going to hear Democrats encourage banks to make lending decisions based off woke politics rather than creditworthiness. We're going to talk about social issues rather than economic issues, though we're an economic committee. But that's not all. Unelected bureaucrats, congressional Democrats, and the Biden administration have conspired to create uncertainty and stifle innovation in our financial system. This will create long-term problems. They're targeting essential and popular products and services used by millions of consumers, such as overdraft protection, peer-to-peer payments, and buy now, pay later. These policies limit options for consumers at a time when they can least afford it and make it more challenging for financial institutions to innovate and compete. Coupled with reckless spending, Democrats' bad policymaking is devastating Americans' budgets. The price of gas is still higher today than it was a year ago, and that threatens to spike again this winter. Groceries are more expensive, up more than 13% from this time last year. Biden's inflation continues to clobber American families. Last week's CPI numbers showed prices continue to rise at 8.3% over the prior year and up over the month before. Everything costs more now, and low to middle income Americans are hurt the most. Add to all this the looming housing crisis. In an inflationary and rising interest rate environment, consumers are already having a harder time accessing affordable credit. Families are being priced out of the housing market because the Fed is forced to keep raising interest rates as Democrats continue to dump jet fuel on their economic dumpster fire. It's offensive to all the senses. And if none of that bothers you, how about this? The Biden administration is treating the U.S. Treasury like it's its own mega bank, doling out $500 billion in taxpayer dollars to repay student loans. And that economic concept is that the same folks that are paying for someone else's American dream can no longer afford their own. You're taking from some and demanding the populace, some who couldn't afford to go to college, demanding that they pay for those that have debt that they shouldn't have taken. So we should focus on those issues. We should focus on the substance of how the American people live and seek to work. That should be the discussion of today. We have an economy that's in an inflection point. We should focus on that. We should talk about the regulatory challenges of giving consumers the options that they want and demand. That should be the focus of this hearing if we're going to even have a hearing like this. And then we should be about the substance of making people's lives better by reducing regulatory barriers that make products more expensive and make life harder for average Americans. My colleagues have instead called on large bank CEOs to publicly pressure them to promote divisive partisan priorities. We'll hear a lot of that. In fact, you might hear from both sides, by the way, where we are a month before the election. Instead of focusing on what your institutions do best, providing capital and serving customers, you're here. It's a shame, it's theater, and it offers zero solutions to millions of Americans who are bearing the financial brunt of the Democrats' virtue signaling. I yield back.
Thank you very much, Ranking Member McHenry. I now recognize the gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, for 1 minute.
Thank you, Madam Chair. Good morning and welcome to our committee. If there's anything that's built on trust, it's banking. And the banking sector lost a lot of trust in 2008, but with the passage of Dodd-Frank and disciplined and prudent operations, our banks are now well capitalized. Banks have been a source of strength during the pandemic and in many cases have made progress in restoring consumer trust over the last decade. But it's not all sunshine and roses. This committee has heard reports of modern-day redlining, high and misleading fees, and unfair use of credit scores. According to the FDIC, 1/3 of unbanked households don't use banks because they don't trust them. Other consumers are turning to risky cryptocurrencies to avoid the system altogether. I hope today's hearing can be productive dialogue on how to continue to instill trust in our banking system and ensure it works for everyone. With that, I yield back.
Thank you very much, Mr. Perlmutter. I want to welcome today's distinguished witnesses to the committee. First, we have Andy Cesari, who is the Chairman, President, and CEO of U.S. Bancorp. Next, we have William Dimchak, who is the Chairman, President, and CEO of the PNC Financial Services Group. Next, we have Jamie Dimon, who is the Chairman and CEO of J.P. Morgan Chase & Company. Next, we have Jane Frazier, who is the CEO of Citicorp. Next, we have Brian Monahan, who is the Chairman and CEO of Bank of America. Next, we have William Rogers, Jr., who is the Chairman and CEO of Truist Financial Corporation. And finally, we have Charles Sheriff, who is the President and CEO of Wells Fargo and Company. Without objection, your written statements will be made part of the record. Each of you will have 5 minutes to summarize your testimony. You should be able to see a timer on your screen that will indicate how much time you have left, and a chime will go off at the end of your time. I would ask you to be mindful of the timer and quickly wrap up your testimony if you hear the chime. Before we begin with your oral testimonies, I'd like to swear in the witnesses. Would all of you please raise your right hands? Do you solemnly swear or affirm that the testimony you will give before this committee in the matters now under consideration will be the truth, the whole truth, and nothing but the truth, so help you God? Let the record show that all of the witnesses answered in the affirmative. You may be, of course, you are already seated, and we will now begin with your oral testimonies. Mr. Cesari, you are now recognized for 5 minutes to present your oral testimony.
Good morning and thank you. Chairwoman Waters, Ranking Member McHenry, and distinguished...
And will you speak directly into the microphone and with a voice that everyone can hear you?
Certainly. Good morning, and Chairwoman Waters, Ranking Member McHenry, and distinguished members of the committee. Thank you for inviting me to speak with you today. U.S. Bank is based in Minneapolis, Minnesota, and holds one of the longest active banking charters in the United States. We have spent nearly 160 years serving individuals, families, businesses, and communities, and striving to be a responsible and innovative leader in the financial services industry. At U.S. Bank, we operate a simple, straightforward company with 4 core businesses: consumer and business banking, corporate and commercial banking, payment services, and wealth management and investment services. We have earned a reputation for being well-managed, financially sound, and responsible in our approaches to underwriting and risk. Because of this, we have one of the highest debt ratings, and we have been recognized for 8 consecutive years as one of the world's most ethical companies. These achievements are possible only because of our exceptional team members. We work hard to take care of their needs and invest in their career growth and development. This commitment has been further reflected in our newly expanded leave benefits and our recently announced increases in entry-level pay. Thanks to our incredible team, we provide exceptional banking experience to our customers. Our retail banking services are accessible when, where, and how our customers prefer, whether virtually or in person in one of our retail branches, which we operate in 26 states. There are a few areas of our retail banking business that I want to highlight today. First, we have pioneered several digital enhancements. In addition to our award-winning mobile app, we created a tool for our bankers to co-browse remotely with their customers on video. This solution helps customers feel heard and understood when they need help making important financial transactions. Second, we have made it easier for individual customers and small businesses to access credit. I know policymakers on this committee have been seeking a short-term, low-cost, small-dollar solution for people who have emergency cash needs. 4 years ago, we provided a solution for our customers. Our Simple Loan product allows customers to receive a loan of up to $1,000 in a matter of minutes on our mobile app. We similarly streamlined our services for small businesses. We now can process and fund a small business loan in less than 15 minutes. And thanks to our investments in new point-of-sale technologies, our small business customers can more easily manage their money and serve their customers. Third, we are working to make home ownership a reality for more Americans across both rural communities and in our country's cities. One such initiative we launched is Access Home, a program designed to increase Black home ownership by engaging with community partners. We continue to provide mortgage services to local housing finance authorities, as we did throughout the pandemic, and we are a leading FHA lender. Our commitment to serving the financial needs of Americans truly includes all Americans. We recognize that being a good corporate citizen goes beyond providing world-class financial services. In 2021, we developed our Access Commitment, a multidimensional initiative to work to close the racial wealth gap across communities. Fulfilling these commitments is important to me, and we have made substantial progress. Last year, we provided nearly $200 million in capital to Black-owned or led businesses and organizations. We made a $305 million loan commitments to CDFIs, and we have made supplier diversity a priority and are spending nearly $500 million on these efforts annually. Still, we have pledged to do more. In addition to our commitment to closing the racial wealth gap, U.S. Bank is also committed to promoting diversity. The commitment starts with me, and I have seen the firsthand of the benefits of championing diversity at U.S. Bank. Diversity strengthens our business, attracts talent, and allows us to better serve our customers. Our efforts in this area have been recognized earlier this year. Diversity Inc. named U.S. Bank to the top 50 companies for diversity for the 4th year in a row. In closing, we believe relationships are a key differentiator for our bank. That is why we are taking the best of our person-to-person interactions and enhancing them with new digital capabilities to connect our customers with their trusted partners and advisors. Today, as always, our focus is on serving people. Relationships are the center of our business and the core of all the communities we serve, and that commitment will never change. With that, thank you for your time and for the work you do for our country. I look forward to your questions. Thank you.
Thank you very much, Mr. Cesare. We will now go to Mr. Demchak. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, and Chairwoman Waters, Ranking Member McHenry, and distinguished members of the committee. I'm pleased to be here on behalf of PNC Financial Services. PNC is a Main Street banking organization focused on traditional banking activities. We've essentially been in the same business for 170 years, which is when we were founded. Our priority's always been to help customers save, borrow, and move money. You know, we are a large bank by historical standards, but we're just 1/6 the size of some of the banks represented on this panel. We have limited capital markets activities, limited derivative and foreign operations. PNC is not a global, systemically important bank. What we are is a financially strong and resilient bank that's committed to serving consumers in a fair and transparent way. I am proud that PNC was the first large bank to actually modify its overdraft practices. Since the rollout of our low cash mode product, overdraft fees at PNC have dropped by nearly 50%. We've also made it easier for consumers to send and receive payments. PNC, along with the other owner banks of early warning services, developed and rolled out Zelle, a real-time P2P platform. Zelle provides consumers with a free and convenient way to send money to individuals and businesses. And despite the headlines, disputes within the Zelle network make up less than 10 basis points of all transactions. This is not true of unregulated P2P digital payment services, which in at least one instance, in PNC's case, has 13 times the disputes that we see on the Zelle network. But better is not good enough, and scams in particular continue to grow across the financial ecosystem. Scams are different than traditional fraud in that a bad actor gets a customer to actually initiate the transaction themselves. These scams are growing daily, and the industry, regulators, and importantly, legislators need to respond. It's not enough that we apportion blame after the fact. We need to stop fraud and scams before they occur. Secure networks like Zelle, real-time payments, and potentially FedNow allow for direct authentication with a host bank. They also allow members of the network to identify, close, and police against scam accounts. This is not the case with non-bank networks. These networks are not held to the same security standards as banks. When a scam occurs, banks like PNC have zero visibility into where the money went, zero capability to recover the money, and zero capability to close the bad account. Banks follow the standards set under Gramm-Leach-Bliley Act and are regularly, almost continuously, examined for compliance. Non-bank data aggregators are not subject to examination and supervision. Instead, they hold the financial data of tens of millions of U.S. consumers and rely on screen scraping to gather and then sell that consumer information. 12 years ago, the CFPB was given authority based on Section 1033 of the Dodd-Frank to end screen scraping, to secure data, and to stop the reselling of confidential consumer data through the fintech ecosystem. This hasn't happened, and consumers are paying the price. PNC's had a social purpose since the day it was founded. As a service organization, we believe our success is directly tied to the success of our communities and customers and communities. We succeed when our customers and communities thrive and when our employees feel valued and are rewarded for helping fulfill our purpose. Our commitment to our communities is reflected in PNC's outstanding rating under the Community Reinvestment Act, a rating, by the way, that we've enjoyed since the enactment 40 years ago. We also succeed by being diverse and inclusive, which starts at the top of the organization. Today, nearly half of our independent directors on our board are women or people of color, and half of the executives that report to me are women or people of color. I am honored to represent the nearly 60,000 PNC employees who work hard every day to help our customers and deliver for our communities. It's a safe assumption that all of those constituents are as divided on the views of today's challenges as everyone else in our country. Our job as a bank, and my job as a leader, is not to arbitrate on who is right or wrong, but rather to find common ground and deliver on our promise to serve customers, keep them safe, and to provide capital to our great economy so that everyone may prosper. With that, I welcome any questions that you may have.
Thank you, Mr. Demchak. Next, we will go to Mr. Diamond. You are now recognized for 5 minutes to present your oral testimony.
Chair Waters, Ranking Member McHenry, and members of the committee, I appreciate the opportunity to talk about J.P. Chase, the role of America's largest banks as a force for good for the country, its citizens, and the global economy. We live in the greatest country in the world, predicated on foundational beliefs in freedom of speech, freedom of religion, freedom of enterprise, the sanctity of the individual, and the promise of equality and opportunity for all. These core values are the fabric that bind us as Americans. We're the best of what shines through, especially in times of adversity. This system has created what is still the most prosperous and innovative economy the world has ever seen, and one that nurtures vibrant businesses, large and small, and a welcoming environment for innovation, science, and technology. My enduring faith in the strength of the country remains as strong as ever. The free flow of credit and investments is key to our nation's global competitiveness. Free enterprise is the flywheel of the economy as capital seeks out investments, individuals, and ideas that drive growth and innovation. As free enterprise celebrates and is inseparable from human freedom and innovation, which ultimately are the stimulus for human progress. The secret sauce of free enterprise is not only the free movement of capital, but more importantly, the value of knowledge and free people exercising their rights. What this country needs most is free enterprise, extraordinarily competent government and policies, and more civic-minded companies and citizens. The work we do at J.P. Chase matters in good times, but particularly more in tough times. We provide critical financing to nearly every sector, including manufacturing, service, energy, real estate, and transportation. Importantly, we finance federal, state, and local governments, schools, bridges, hospitals, and universities, and transit. We have long championed the essential role of banking in a community, its potential for bringing people together, for enabling companies and individuals to reach for their dreams, and for being a source of strength in difficult times. We finance Americans' ambitions with loans for homes, autos, and growing small businesses, and we provide valuable products and services to more than half of American households. We know that our business is only as strong as our communities, so we are focused in lifting up traditionally underserved communities by increasing home ownership, expanding affordable rental housing, and growing small businesses. The last few volatile years have brought stress and disruption to so many as the world grapples with war in Ukraine, economic volatility and inflation, energy insecurity and climate change, and a pandemic. It has also shown what great companies with the size and scale of J.P. Chase can do as a source of strength to the economy. Because we have a strong and healthy company, we consistently serve and finance American households and businesses while building our communities and protecting America and the American economy. We are all here guardians of the financial system. We support our government and national security efforts to combat financial crimes, and we carry out complex sanctions. Each year, we proactively identify nation-state and cyber-criminal threats and work closely with financial services and energy industry and with the United States government to help protect critical infrastructure. And we fuel good American jobs. The businesses we all finance collectively employ hundreds of millions of Americans, and as a large employer ourselves, we employ people in every state in the country with starting wages that far exceed any government minimum wage, plus full benefits, retirement, job training, and career growth opportunities. I want to close by thanking the more than 200,000 employees of JPMorgan Chase. I would like the public to know how proud I am of these people who work in every state in the country. You all work tirelessly for our customers with a singular focus on doing the right thing. You work on behalf of our shareholders, real people and communities, including teachers, law enforcement, healthcare workers, and the people saving for retirement. Many of you have faced personal challenges throughout the pandemic, whether it's your own health or the health of a loved one, or managing your children's education and child care needs. At the same time, our work has never been more important or more difficult in the last several years. You continue to persevere with grace and a fortitude that makes me proud. I've been particularly moved by our essential worker population, the tens of thousands of you who continue to come to work during the height of the pandemic to serve our customers when they needed you the most. You have my deep gratitude. And for all JPMorgan Chase employees who perform your jobs with integrity and excellence every day, you embody the best of American values and make your country proud. Thank you, members of the committee, for the work you do for our country. I look forward to working with all of you to help solve the challenges facing our country and help grow and safeguard this great country. Thank you.
Thank you, Mr. Diamond. Next, we will go to Ms. Frazier. You are now recognized for 5 minutes to present your oral testimony.
Thank you very much indeed, Chairwoman Waters, Ranking Member McHenry, and members of the committee. Good morning, and thank you for the opportunity to represent Citigroup today. When a similar group convened with this committee last year, we shared how our banks supported the economy during the global pandemic. Today, while the worst of COVID may be behind us, the economic challenges we are facing are no less daunting. The reforms you put in place and the work we've done since the financial crisis to strengthen our bank's financial foundation have enabled us to continue to serve as a source of stability. While today I am a proud American citizen, as someone who grew up in the UK, I can attest that the banking system and the capital markets in the States are the envy of others. Our financial institutions and our financial markets, they're essential to American competitors abroad, and they're a reason why the US is the top destination for foreign investment. As living expenses for Americans increase and concerns about the economy grow, we remain very focused on our role as a bank in job and in wealth creation. Through Citi's extensive global network and footprint, we partner with the most iconic American businesses, as well as the federal government, to help them navigate the global economy. We've been supporting our clients as they build resiliency, reconfigure supply chains, and adapt to inflationary pressures. And we help these institutions invest in projects that put them in a position to succeed in the 21st century. And it's these investments that put a lot of people to work in the US. The private sector clients we serve are where millions of Americans proudly earn their living. And those clients rely on vendors and suppliers that in turn employ millions here at home. At Citi, we employ 70,000 people here in the US, working in cities across the country, such as Jacksonville, St. Louis, and Los Angeles. The work we do with our public sector partners is a prime example of how we put our balance sheet to work to benefit local communities. In 2021, we partnered with state and local governments to catalyze more than $27 billion in infrastructure investment, such as schools, hospitals, and roads. And many of these large projects, they just wouldn't have been possible without a bank of Citi's scale to back them. We financed more than $5.6 billion in affordable housing projects. Last year in communities across 32 different states, from California to Ohio to New York. And this total made us the #1 affordable housing lender in the US for the 12th year in a row. Breaking down the barriers to banking is also a top priority for us. In fact, this past summer, we became the first of the largest US banks to completely eliminate overdraft fees and returned item fees for our customers. We have been a leading proponent of pay equity. Earlier this year, we launched a first-of-its-kind diverse financial institutions group to lead our engagement with minority depository institutions and diverse broker-dealers and asset managers. And this group is focused on helping these diverse institutions scale and expand into new markets. And it includes a groundbreaking rotational program that embeds city executives within MDIs for up to a year. So bottom line, my city colleagues and I understand and embrace the responsibilities that banks play in advancing economic empowerment and mobility. I hope my pride in City's story has come through, but I also want to be clear about recognizing the need to continue improving as we strive to build an even safer and sounder bank for the future. Thank you for your opportunity to speak with you about the work we're doing to support American consumers and businesses, and I look forward to your questions later on today. Thank you very much.
Thank you very much, Ms. Frazier. Next, we will go to Mr. Monahan. You are now recognized for 5 minutes to present your oral testimony.
Thank you, Chairwoman Waters, Ranking Member McHenry, and distinguished members of the committee. Good morning to all of you. It's an honor to be here to represent my 210,000 plus teammates at Bank of America and to talk to you about how we deliver responsible growth. This is how we run our company. It's the same thing I told you last year and the year before every time we've done these hearings. We deliver for our clients, for our teammates, for our communities, and for our shareholders. We believe in delivering both profits and purpose. That includes being a great place to work, which is a core tenet of responsible growth. We invest heavily in our teammates and our families. This year, we raised our U.S. minimum hourly wage to $22 and are on track to increasing to $25 by 2025. We also made an across-the-board pay adjustment for all our U.S. employees mid-year in the late spring that are earned under $100,000 to increase their wages by 3 to 7% based on years of service. This is above and beyond any BAU pay review cycle. For the 5th time this year, we delivered special compensation awards to our teammates. This year, $1 billion over and above other compensation to 97% of employees. We again did not raise medical premiums for teammates that earn under $50,000, the 12th year in a row we've done that. Our global workforce is 50% women, and 49% of our U.S. teammates are people of color. Our management team is 55% diverse, including 32% women. Our board is 53% diverse, including 33% women. We also continue to help our clients manage their financial lives. Over the past year alone, our lending to individuals and families grew by 9%, and our loans to small businesses grew by 8%. We're the top small business lender with $22 billion in outstanding small business loans today. Our brand and customer scores are in the best sustained shape we've ever seen. We support our clients with $1 trillion in loans to help them live their financial lives. We hold $1.9 trillion of their deposits to help them also. 95% of our PPP loans have been paid off or forgiven. We continue to expand our nationwide network of financial centers and our industry-leading and award-winning digital capabilities. Through both, we deliver transparent, easy-to-use products and services that help our clients save, spend, and borrow. As an example, beginning in 2009, we began to take steps to empower our clients to reduce overdraft usage. We first eliminated overdraft fees for clients when using debit cards at point of sale and have not allowed opt-in for a dozen years. We also have created no overdraft fee accounts, now over 4 million in our client base. We've since eliminated fees for non-sufficient funds on our consumer deposit accounts. We reduced overdraft fees from $35 to $10 per occurrence, and we removed the ability to overdraft an ATM. You can see that in the second quarter call reports that show our non-sufficient funds and overdraft fees are down 66% from last year's second quarter. Now, responsible growth also shows how we make an impact in communities where we live and work. In 2021, we continue our long record with $375 million in charitable giving. Our teammates reported 1.6 million volunteer hours during the year. We also continue to be a lender and support our small businesses and entrepreneurs in our communities. We provide more than $2 billion to CDFIs to finance affordable housing, community facilities, and small business. We have invested in the common equity of dozens of minority deposit institutions and have $100 million plus of deposits with those institutions. We've also committed in a unique program $350 million to over 100 private equity funds that are run by women and minority entrepreneurs as private equity partners and invest in companies with like owners. Responsible growth requires us to work with clients of every size and every sector to support a just transition to a sustainable future for the energy security for the United States and around the world. We believe that capitalism remains the best way to tackle the big challenges facing society. We all face a transition to a secure energy environment. The private sector has the funding, the scale, the long-term thinking to help with its toughest issues, including those. In 2021, we had $250 billion in loans and other support to clients in the area of sustainable finance. This includes more than $150 billion focused on a clean energy transition. We work with all companies in the energy sectors, oil and gas clients who are also investing to help drive clean energy solutions. Responsible growth also means delivering for our shareholders. We delivered strong profitability and returned billions of dollars to shareholders in dividends and stock repurchases. But our balance sheet, capital, and liquidity are the strongest in our company's history. This is responsible growth. This is capitalism in action. Thank you, and we look forward to your questions.
Thank you, Mr. Monahan. Next, we will go to Mr. Rogers. You're now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, good morning. I'm Bill Rogers. I'm the Chairman and CEO of Truist. I'm extremely proud to be here on behalf of Truist's 50,000 purpose-driven teammates, and thank you for this opportunity to testify today. Truist is a purpose-driven company, and that purpose is to inspire and build better lives in communities. This drives our mission for our teammates, our clients, and the many communities and stakeholders that we serve. For teammates, our mission is to create an inclusive and energizing environment that empowers teammates to learn, grow, and have meaningful careers. Truist's minimum starting pay of $22 per hour is among the highest in the industry. Our career development programs provide a pathway to professional growth. They include offerings at the Truist Leadership Institute, as well as tuition reimbursement for education that supports career advancement. We've also accelerated career development for Truist leaders from diverse backgrounds, which has helped us meet our goal of 15% diverse representation in leadership roles a year ahead of our original target date. To help ensure our teammates' financial security extends into retirement, we offer eligible teammates both a defined benefit pension plan and a 401k match at perhaps the highest level in the industry. For our clients, our mission is to provide distinctive, secure, and successful client experiences through touch and technology. We recently launched Truist One Banking, which includes 2 new deposit accounts with no overdraft fees, as well as other features to accelerate our clients' journey towards financial well-being. Today, 87% of our client interactions occur digitally. We're evolving our products and services to help ensure we continue to offer a best-in-class client experience that's intuitive, efficient, and secure. Client security is a Truist priority, and my written testimony outlines actions we are taking to protect our clients. We welcome opportunities to work more closely with law enforcement and policymakers at every level to help protect our banking system from organized and sophisticated criminal attacks. Even when most client interactions occur digitally, exceptional client service also often requires the personal touch that our Truist teammates provide. Personal touch made the difference for many of our clients navigating the PPP process. At the outset of the pandemic and in the middle of our merger, thousands of our teammates worked directly with their business clients to meet their fast-changing financial needs. I'm extremely proud and appreciative of the client letters we received, thanking our teammates for their help in securing PPP loans that kept their small businesses open and their employees employed. For the many other stakeholders we serve, our mission is to optimize long-term value through safe, sound, and ethical practices. Truist is a Main Street bank, and teammates serve our clients at more than 2,000 branches in 17 states and Washington, D.C. We're committed to being a good neighbor and contributing back to the communities where we do business. In 2019, we committed to a $60 billion community benefits plan, which included mortgage lending for low and middle-income borrowers, commitments to small businesses and community development lending, community development grants, as well as the establishment of 15 new branches in LMI communities. I'm pleased to report that through August of 2022, we estimate that our combined lending, investing, and philanthropic financing activities already exceeded the $60 billion mark, and that we'll open 16 new branches in LMI or majority-minority communities by the end of this year. In addition, Truist has been a strong supporter of MDIs and CDFIs. In 2020, a $40 million Truist donation helped establish Corner Square, a new nonprofit that provides capital to racially and ethnically diverse small business owners. In 2021, Truist committed $50 million to serve as an anchor investor, along with Microsoft, on FDIC's mission-driven institution investment fund. And in June, Truist committed an additional $120 million to strengthen and support small businesses with a focus on Black, Latina, and women-owned businesses. I'm inspired by this opportunity to lead this purpose-driven company and serve our clients and our teammates in our communities. Thank you for this opportunity to share our purpose journey with you, and I look forward to your questions today.
Thank you, Mr. Rogers. Next, we will go to Mr. Sharp. You are now recognized for 5 minutes to present your oral testimony.
Chairwoman Waters, Ranking Member McHenry, and members of the committee, good morning, and thank you for the opportunity to be here today. Since October of 2019, I've had the privilege of leading Wells Fargo. As I reflect on my time at the company, I'm incredibly proud of how we've used our strength during difficult times to support our customers, employees, and communities we serve, while we've worked to transform the company at the same time. I believe that our nation benefits from a strong Wells Fargo, and that has never been more true than today. The last time I appeared before this committee, the country was in the middle of a pandemic, and my testimony and many of your questions were focused on what banks were doing to support the communities in which we operate. Those were important questions then, and they're equally important today, given the complexity of today's high inflationary environment. Since 2020, Wells has provided billions of dollars in emergency lending to America's small businesses, and we donated approximately $420 million in fees from that lending to small business owners who struggled during the pandemic through our Open for Business Fund. These funds are estimated to have reached more than 150,000 business owners nationally and preserve approximately 250,000 jobs. Last year alone, we helped more than 500,000 homeowners with new low-rate loans to purchase a home or refinance an existing mortgage, and we closed billions of dollars in new commitments in affordable housing. Between 2017 and 2021, we increased average wages for our U.S. hourly employees by nearly 25% and increased investments in our U.S. employee benefits by over 20%. And we launched a unique special purpose credit program committing $150 million to help eligible Black homeowners lower their interest rates and reduce their monthly payments. In addition, we issued a second sustainability bond in the amount of $2 billion that will finance projects and programs supporting housing affordability, economic opportunity, renewable energy, and clean transportation. Our work is bolstered by our Banking Inclusion Initiative, a 10-year program to help unbanked individuals gain access to affordable, mainstream, digitally enabled accounts. Though our work is not complete, Wells Fargo approaches issues differently and is a better company than when I arrived. We have driven a tremendous amount of change and established a much stronger foundation for the long term with a clear sense of urgency on building our risk and control infrastructure. We have changed our operating structure, simplified our business, and have a new leadership team in place with the necessary skills and experience to transform Wells Fargo. Almost 70% of our company's operating committee is new to the company since I joined. Additionally, well over half of the senior-most people, meaning those who are one level below the operating committee, are new to their roles. We have also meaningfully improved diversity in our senior ranks. Additionally, last week we announced that we'll commission an external third-party racial equity audit. The assessment will focus on elements of Wells Fargo's efforts to serve diverse communities and promote a diverse workforce. Commissioning this work is a critical next step in reinforcing our commitment to racial equity and helping close the wealth gap in this country. Looking forward, I recognize that the country may be facing uncertain economic times for months to come. I can assure you that Wells Fargo is keeping a close eye on consumer spending and credit trends, and we will continue to be a constructive partner in forging an inclusive recovery. We recognize that COVID-19 has left many people still in need, and the current inflationary environment has added stress. As a company, we will continue to provide support to our customers, employees, and communities over the long term. In conclusion, I want to express my sincere gratitude to everyone at Wells Fargo who has continued to serve our customers, each other, and our communities through these challenging times. I appreciate their dedication and resiliency as we have worked to make Wells Fargo better. While we still have much more to do, our foundation is stronger, our business is more focused, we are driving cultural changes, and the changes we have made to the company are making a positive impact. I'm confident that we have the management team in place to complete the work ahead. Thank you. Welcome your questions.
Thank you very much, Mr. Sharp. I now recognize myself for 5 minutes for questions. Mr. Sharp, I recognize that you have only been the CEO a little less than 3 years, and I remember the commitments that you have made, and I'm listening to what you consider has been your progress since you've been there. Your commitment was to clean up the culture of corruption that existed in Wells Fargo. Since you last testified, the OCC fined your bank $250 million for violating a previous consent order regarding risk management and for engaging in unsafe and unsound practices related to serious deficiencies in your home lending loss mitigation program. In May 2022, the New York Times reported that current and former employees of Wells Fargo described hiring practices that led to fake job interviews so that internal diversity goals could be achieved. A 2021 report by the Committee for Better Banks found Wells Fargo failed to sufficiently disclose employment diversity data, making it impossible to examine advancement opportunities for workers of color. One Wells Fargo employee, Ted Laurel, who is a call center worker in San Antonio, Texas, responded to the last report saying, and I quote, "It's extremely deflating to be a person of color at Wells Fargo. In the past couple of years, I've watched a handful of Black managers at Wells Fargo get fired or leave," quote unquote. Mr. Sharp, I know the bank has made various commitments to address the racial wealth gap, and you have finally agreed to do a racial equity audit. I also appreciate that Wells Fargo is one of the few banks that have maintained a presence in the Caribbean as a correspondent bank, while, of course, we had Citi who responded to us when we were in Barbados that they had closed their correspondent banking operations. And so I do appreciate, but it is not all clear that you're doing enough to finally break the pattern of repeat offenses. To take another example, a Bloomberg investigation found that Wells Fargo approved fewer than half of Black homeowners who applied for mortgage refinancing in 2020, the worst Black approval rate compared to other major lenders. I know you will point to things like FICO score, requirements of the GSEs, but this doesn't fully explain why your bank was comparatively worse in this mark compared to other major lenders. When you look at this track record and when you hear feedback like that from your own employees, what is your assessment of your performances since you last testified before us? And so, you gave us some indication, but would you respond to the fines and the criticisms at this point?
Chairwoman, first of all, thank you for the opportunity to address those things. I was brought in to bring about substantial change at Wells Fargo, and we have made tremendous changes. I've also been very clear since the day I arrived, including when I testified in front of this committee in March of 2020, that it was going to take multiple years to make all of the changes that were necessary so that the company was run in a way that I'd be proud of, our regulators would be proud of, and you'd be proud of. We've closed 4 consent orders since I've been there. We have returned our CRA rating to outstanding. We have plans in place for all of the remediation work that has to take place, and I firmly believe that we are making progress across that body of work. And as I said in my remarks, I'm very confident that we've got the team in place, but that we also have the processes, the discipline, and the sense of urgency to get done what is needed.
If I may interrupt you, will you respond to the accusation of fake interviews? What does that mean to you? And I think you've heard this criticism.
Congresswoman, no one should go through an interview without the belief that they could have a reasonable shot at getting that job. We firmly believe that having a policy in place that requires diverse candidates helps us attract the best candidate. We believe that that's in fact what the policies that we put in place is happening, and that's the reason why our diverse hiring is up substantially since we put these policies in place. And to the extent that anyone feels as if they've not been treated properly, that's something that's on our management team to ensure it doesn't happen.
Is it true that you interviewed African-American employee for a position after you had already hired a white employee? Is that true?
Chairwoman, we're in the middle of continuing an investigation to make sure that we understand every instance where people felt as if they were not treated fairly. And if we have findings, we will take the appropriate action.
Thank you very much. At this point in time, I will call on the gentleman from North Carolina, Mr. McHenry, who is the ranking member of the committee. You're now recognized for 5 minutes, Mr. McHenry.
Thank you for your testimony. Let's talk about the main thing. The main thing here is the economy, the state of the economy. We see a changing rate environment that has a severe impact on financial institutions and families. We see it first with the housing market, 7 months of receding home sales and in a time where we need more housing units in America. We see inflation eroding families' budgets on a weekly, monthly basis, made worse by policies out of Washington. So let's talk about inflation. I want to know the impact as you see it. Ms. Frazier, you have a global footprint. You're in jurisdictions that have rampant, persistent inflation. There's huge pressures placed on consumers and businesses in that environment. What are those economic consequences and challenges of a high inflation environment?
Thank you very much for the question, Congressman. We are very concerned about the high prices that consumers are facing in America and indeed around the world. We certainly have lived through very unusual times through the pandemic, through the recovery from that, and then the impact greatly exacerbated by the war in Ukraine. So the impact of the higher rates that are required to try and tame the inflation is likely to be moderating growth in America and around the world, and will be putting pressure on many of the drivers of the recovery that we've been looking for.
Well, you have this backdrop of the economy, and all of you are making decisions for institutions. In our economic system in America, banks are a key piece of our economic system. And the multiplier effect that you all provide, and the lending and the risk you take in our environment, in our economy. So let's talk about regulatory capital and what that would do. Truist. In the regional banks are, we've heard from federal banking regulators, additional long-term debt requirements potentially placed on institutions like yours. So, Mr. Rogers, what effect would that new layer of capital requirement have on an institution like yours and your customers?
Ranking Member, thank you for that question. And first and foremost, I mean, we think that regulation ought to be tailored and follow the risk of individual institutions. and I think that's consistent with a philosophy that we all support. Additional capital at higher cost costs us to actually potentially impair lending or slow down our lending. It may cause us to do other things from a competitive standpoint to cover the cost of additional capital.
Is that what U.S. Bank thinks, Mr. Seri?
Thank you. We continue to have a very simple business model, and although we are larger than we were a few years ago, the businesses that we're in are substantially the same. Our capital levels since 2007 are actually 3x what they were at that time. So we believe we have a very strong capital rating, which is reflected in our high debt rating. Additional capital will increase the cost of debt.
Mr. Diamond, you spoke yesterday about additional requirements for regulatory capital and liquidity standards and the impact it would have on the marketplace. Will you speak to that?
Yes, sir. So to give credit where credit is due, Dodd-Frank accomplished a lot of what needed to be accomplished. Lehman Brothers would not happen again. I think the regulators should take a victory lap for that. Having said that, as often happens, things went a little bit too far. So it's not just capital, liquidity requirements, international requirements, Basel requirements, et cetera, do restrict lending, raise the cost of lending, damage markets a little bit, reduce mortgage lending on the part of some of our banks. We want good regulations. I think we need to spend a little more time at recalibrating the effect of these regulations, across the whole financial system.
So there's a cost to this, and there's an economic cost, and it changes behavior at the institution, which means you don't lend as aggressively on the margins.
Yeah, and unfortunately, some of that's going to happen when things get worse. So J.P. Morgan will be sitting with $1 trillion, unable to deploy it to help our clients to intermediate markets at precisely the wrong time. So you all saw Treasury markets, other markets get very rattled in March 2020, going back to 2019, and part of the reason was the inability of very well-capitalized, very liquid banks unable to do what they really should be doing to help clients.
Which means you can't provide liquidity in the system at end of quarter, end of year, and so we're going to have choppier markets as a result of regulatory policies that impair your ability to make markets. Is that how you see it, Mr. Moynihan, with Bank of America?
There's no question that increasing capital for us 1% makes us not be able to lend $160 billion of loans into the economy. It's that straightforward. It's a simple calculation.
So there's an economic cost to regulatory capital requirements that are beyond what is economic or historic needs for your institutions. Thank you for testimony.
Thank you very much. The gentlewoman from New York, Mrs. Maloney, who is also the chair of the House Committee on Oversight and Reform, is now recognized for 5 minutes.
Quickly. You're ready. Hi, thank you so much, Chairman Waters, for calling this important meeting, and all of our panelists. I thank you for all of your comments, particularly those who talked about wanting to reduce overdraft fees that drain billions of dollars from America's poor and working class communities every year. The Consumer Financial Protection Bureau has found that overdraft fees cost our consumers over $15 billion in 2019 alone. And these fees disproportionately target and penalize low-income consumers. They found that almost 80% of overdraft and non-sufficient fund fees are borne by only 9% of consumers, and they are all financially vulnerable. While I'm glad to see some banks have taken some initiative by eliminating or moving in that direction, it's concerning to me that it's taken this long and that many banks still have yet to make any voluntary changes. And with banks enacting different policies, consumers are left with little consistency. They're very confused by these different policies. We must ensure that we have a comprehensive, permanent solution enacted to protect consumers, and that's why I have introduced the Overdraft Protection Act, which has been reported out of the committee. It builds on the Credit Card Bill of Rights, which passed in 2009, and according to the CFPB, has saved consumers over $16 billion a year by keeping fees in their pockets. I want to, in the consumers' pockets, I want to ask Bank of America and Citibank, because in your testimony you talked about your actions to eliminate fees. Can you elaborate what product offerings have you changed to reduce or eliminate the overdraft fees? And can you speak to how your consumer banking division has remained profitable in light of all of these changes? First, Mr. Moynihan, and then Ms. Frazier.
So I think you heard many of my colleagues talk about this, and this is a product in the industry. The first is a no overdraft product, and especially for students and younger people. We have 4 million of those, and I think if you total it up across the board, that product allows people to have no overdraft capacity. Then you have the ability for other products for people to opt in, and what we've done is reduced our overdraft per occurrence fee from $35 to $10. We've reduced the no ability to have the NSF type fees, the numbers of occurrences. So all that totals up that we're down 60% second quarter last year, second quarter this year, and it'll fall further because a lot of those changes took place, and we recently announced that it's down 90%. But we're able to do that because of the scale and capabilities of our team in consumer banking. And these larger banks, in our variety of banks that participate in our system, there's a variety of business models, but one of the things that'll be consistent is the scale we've been able to achieve in our company and these companies at this table have allowed us to pass through those benefits as a consumer and still remain profitable.
Thank you, Ms. Frazier.
Thank you very much, Representative. Lovely to see you. We are proud at Citi to have eliminated overdraft fees and NSFs. This was the right decision for our bank and is reflective of a multi-year commitment to having a customer-friendly approach to fees. Similar to my colleague, Mr. Moynihan, we also have a product called the Access product. It accounts for almost 20% of all of our accounts, in addition to the no overdraft, also is a very low-cost, customer-friendly account that has been growing substantially over the last few years and played a very important role during the pandemic for those who are most affected. It's something that we're committed to continuing to grow. Thank you.
Well, I want to. Is there any other banks that can commit to eliminating overdraft fees altogether by 2025? Anyone else on the panel that can follow the leadership of these two banks? Then I'd like to move to the interest rates that are rising and causing problems or challenges with the housing market and making it harder for first-time home buyers to be able to take out mortgages. Again, I'd like to ask both Bank of America and Citibank what you have done. Do you have any programs or ideas of how we can help facilitate home ownership, even with the challenges of increased interest rates? Would be moving the 30-year mortgage to sort of a 50-year mortgage to lower the interest rate payments per month. Would that help? Any ideas that you may have? And after them, anyone else's ideas? First, Mr. Moynihan, then Ms. Frazier.
I think we have programs that provide down payment assistance and grants for that if you get HUD counseling. We have programs to develop housing in our community, develop program $6 billion a year we do in low-income housing development and other types of housing development. So it's a multifaceted thing, but I think in the end of the day, the amount of adjustment that will go on as rates adjust is intended to attack the inflation, and it will take a period of time for that to sort through.
Thank you. The gentlewoman's time has expired. The gentlewoman from Missouri, Mrs. Wagner, thank you, is now recognized for 5 minutes.
I thank you, Madam Chairwoman. I'd first like to note that this is our third time hearing from these witnesses, the second time this Congress, and the majority is likely to make the same assertions that they did last time to name and shame, just to try and score political points. Meanwhile, we have an SEC chair moving at breakneck speed to propose an historic number of rules, more than the SEC proposed even after the 2008 financial crisis. Yet, this committee refuses to conduct any oversight. Why is the majority unable or unwilling to bring in Chair Gensler? The Senate Banking Committee didn't seem to have a problem getting him to testify. Inflation has outpaced workers' wages for 17 months in a row under President Biden's watch, and America's workforce is paying the price. The majority of U.S. workers' income has fallen behind rising costs. Everyday items across the board keep rising in price. The cost of eggs are up 40%, chicken 25%, bread 16%. Instead of addressing this 40-year high inflation crisis, President Biden and the House Democrats spent last week celebrating their reckless spending and failed agenda, while ironically coincided with the stock market crashing and erasing retirement savings for millions of hardworking Americans. The very same day, the Consumer Price Index numbers jumped to 8.3% over last year. The White House celebrated with James Taylor singing Fire and Rain. Well, let me tell you what, the only fire that's raining down on my constituents in Missouri's 2nd Congressional District is the cost of putting food on their table, of gas in their tanks, and to paying their utilities. 1 in every 6 Americans, over 20 million of them, are in arrears on their utility bills, and we haven't even hit winter. Why aren't we having hearings to address the drivers of inflation? The effect that the $5 trillion in Democrat government spending over the last year and a half has had, or the lack of our energy independence, or perhaps the over-regulatory burden of President Biden's administrative state that honestly adversely affects small community banks even more harshly than those before us today. Recent Consumer Price Index numbers showed inflation is not going away anytime in the near future. Everything costs more now, and low to middle income Americans are hurt the most. Mr. Cesari and Ms. Frazier, in your opinion, I know that the ranking member touched on some of the implications of sustained inflation, particularly on consumers' credit and the economy, but in terms of the level of savings and credit card debt, what are you seeing on the ground from your customers, your clients? Mr. Cesari.
Thank you, Representative. You are correct that inflation is impacting those who can afford it the least. While consumer spend levels in total are about 10% above last year, the things that people are spending money on have changed substantially, from discretionary to non-discretionary items like food and gas, as you mentioned. And I think it's appropriate that we're very focused on inflation because, again, it is most harmful for those who afford it the least.
And are you seeing, in fact, credit card debt go up and savings go down?
Savings levels continue to be above pre-pandemic levels across all stratas of deposit levels, from 2 to 4 times. However, they're stabilized. For 18 months, they were growing each and every month, and they've stabilized the last 3 months. Credit card spend rates continue to be high, and payment rates are actually starting to normalize, but still well above pre-pandemic levels.
Thank you. Ms. Frazier, please.
Thank you very much. I would say that it's early days still in terms of seeing the impact of high interest rates on the consumer in the States. Fortunately, they entered this period with pretty strong balance sheets. But we would anticipate that if interest rates remain high in order to tame inflation, that we will see greater stress, particularly in the lower FICO scores, in credit, and that we will also see the savings rates coming down further than we have done. I think we're fortunate to have had the consumer in good health entering into this, but we do expect we're going to be in for tougher times ahead.
Well, I thank you. I've run out of time, and I yield back.
Thank you very much. The gentleman from California, Mr. Sherman, who is also the chair of the Subcommittee on Investor Protection, Entrepreneurship, and Capital Markets, is now recognized for 5 minutes. He's an accountant who understands the inflation is a worldwide phenomenon.
Thank you. For the 2.5 decades I've been on this committee, we've brought the SEC forward to push them because they weren't writing regulations that law required them to write. I want to commend the SEC for beginning to deal with that backlog. I don't criticize them for working too hard. The Inflation Reduction Act reduced the federal deficit by $300 billion, partially ameliorating the inflationary effect of the Trump tax cut, which added $2 trillion to our deficit by cutting taxes for the wealthy and large corporations. And, of course, the Inflation Reduction Act provides tax cuts designed to reduce global warming. Got a lot of questions, got a lot of witnesses. They're designed to be yes or no. ESG investing is for those who want to contribute to society and to the improvement of the environment, which is kind of the exact opposite of giving money to Vladimir Putin. Mr. Diamond, back in March, Politico reported that you were going to mull over the possibility of removing Russia from your ESG fund suite. Has J.P. Morgan removed Russia from its ESG fund suite?
Probably.
Can you get back to us with a definitive answer on that, Mr. Diamond?
Happy to do it.
We clearly have sanctions on Russia and Belarus. There is a loophole in that sanctions that we don't have in our Iran or North Korea sanctions, and that is that the subsidiaries of U.S. corporations are not legally bound. My hope is that the institutions here wouldn't be exploiting that loophole. This House of Representatives in May passed my bill, the Russia and Belarus Financial Sanctions Act, which would block that loophole. Unfortunately, the Senate remains somewhat dysfunctional. So the question is, are you going to exploit that loophole? But I'll be more specific. Mr. Diamond, has J.P. Morgan cut its ties with Gazprom and Vitol?
So first of all, I wouldn't call these loopholes. The American government, the Secretary of Treasury.
Please don't respond. I didn't ask you to respond to my editorialization. Just a specific question. Have you cut the ties to Gazprom and Vitol?
We are following the instructions of the American government as they asked us to do it.
So you are not.
I think they're
so
doing
the
a
answer
great
is,
job.
Mr. Diamond, it's a yes or no question. You have not cut your ties to Gazprom and Vitol. Do you continue to own a major stake in the Russian bank Sberbank?
No, we do not own a stake in Sberbank. I think that's in a
Thank
mutual fund somewhere. And we've materially cut out some of the
I hope you would cut all your
Gazprom.
ties to Gazprom and Vitol, and let me go on to Citigroup. Have you cut your ties with Lukoil and Vitol?
I just had one other thing. I don't think
Not on my time, you can't.
No one is doing
Reclaiming my
anything
time,
No one
Mr.
is
Time
Diamond.
belongs
Here
to
for
the
profit.
gentleman from California.
You can do a press conference afterwards and comment as you like, not on my time. Have you cut your ties to Lukoil and Vitol?
Similar to Mr. Diamond, we have been working down our exposures in Russia.
So you have not
winding
cut
down.
your ties yet. Let's move on. A number of the banks here have said that you're going to cut investment in new coal-fired electric plants. I'll go down the question, though, is, are you going to finance crypto mining, which creates electricity that is then wasted in something that doesn't keep anybody's lights on, doesn't cook anybody's food? Let's go to those. Ms. Frazier, you going to be financing crypto mining?
I do not believe so.
Mr. Moynihan?
We do not have any.
Mr. Scharf?
I'm not aware of any financing like that.
Okay, finally, a capital markets question. We have limits on margin lending designed to protect the lender, and in this case, the lender is you, and you're systemically important to us. It's designed to protect the investor, but most importantly, it's designed to protect the capital markets. That's why on equity investments, we only allow 1-to-1 margin. But the total default swap is a loophole that allowed Arcos to get 9-to-1 margin. Can you commit now to follow the rule that we provide only 1-to-1 margin, or do you want to use loopholes to provide the 9-to-1 margin? I might add that with Arcos, the lenders lost well over $5 billion. Mr. Siri.
We have no relationship with that firm and do not have.
Do you use credit default, these swaps to avoid the margin limit requirements?
Not that I'm aware of, sir.
I believe my time has expired.
Thank you very much. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Sorry, Madam Chair, it was my understanding my colleague, Mr. Posey, was going to be going next. He's on the screen. Just clarifying before we get going on the time.
The gentleman has 5 minutes, full 5 minutes.
But my colleague who's on screen was supposed to be next in line and is ready. He's in between.
The gentleman
things.
from Florida, Mr. Posey, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Diamond, in late May, you told stakeholders to brace yourself for an economic hurricane. What's your current outlook along those lines?
So I think you've heard the American consumer is still in actually rather good shape. They're spending money 10% more than prior years. They have a good balance sheet. Their debt balances are low. Their confidence levels are going up. Jobs are plentiful. I think it's a good thing that wages have gone up for the lower end. That's all the good news. That's being met by other forces, which we don't know the full effect of. That's war in Ukraine, oil prices going up, interest rates going up, inflation, and the worst possible outcome is stagflation. And so those things will absolutely cause a slowdown in the economy, at one point, increase unemployment, and we don't know the full outcome.
In your opinion, what is the most urgent regulatory reform that this committee can make in terms of improving our nation's economic and financial well-being?
I think when you're looking at something like inflation, there are really three things to do. Rates will have to go up. That will reduce demand. I think spending less money reduces demand, and we should also focus on the supply side. And there are evidence in certain areas, mortgages, small business regulation, some capital regulation, but regulations could actually reduce the burden on business and get people to hire more people and produce more products and services.
What role did monetary and fiscal policy, especially the Fed's financing of congressional deficit spending, play in our spiraling inflation, particularly in food and shelter prices and other components of the core CPI?
To give credit where credit is due, I think the government did the right thing early on in the crisis to take dramatic action to reduce the pain of the pandemic. Remember, unemployment went from 4% to 15% in 3 or 4 months. But since then, we've spent, in total, fiscal spending has been $6 trillion, 30% of the GDP, which is bigger than any time in history other than World War II. And QE probably went on for too long, another $3 or $4 trillion. And we're paying the price of too much fiscal and monetary stimulus. I don't want to second guess all the people doing that. That might have been predictable at the time. They're taking the right action to reverse it. But I don't think you can spend $6 trillion and not expect inflation. And so I don't like to cry over spilled milk. Let's do the things we've got to do to fix all that and then move forward, grow the economy, which is the best way to reduce inflation and help all of our citizens.
How likely do you believe it is that the Fed will achieve a so-called soft landing, reducing inflation without an unacceptable decline in economic activity?
I do not like to make forecasts. I don't think I've ever seen anyone forecast the future properly. I look at probabilities. I think there's a chance, not a big chance, a small chance of a soft landing. There's a chance of a mild recession, a chance of a harder recession. And because of the war in Ukraine, I think and the uncertainty that causes in global energy supply and food supply, there's a chance it could be worse. And I think policymakers should be prepared for the worst so we take the right actions if and when that happens.
Are ESG ratings useful in terms of supplying investors with enough information to make intelligent trade-off decisions among economic rates of return and environmental, social, and governance objectives? Or are they merely a rating of past ESG performance?
I think we need more work to make it clear what these ratings are and what they mean.
What do you think our nation's near-term energy strategy should be in terms of traditional energy sources like oil and gas?
We aren't getting this one right. The world needs 100 million barrels effectively of oil and gas every day, and we're going to need it for 10 years. To do that, we need proper investing in the oil and gas complex. Investing in the oil and gas complex is good for reducing CO2, because what you've all seen is that because of the high price of oil and gas, particularly for the rest of the world, you've seen everyone going back to coal. Not just poor nations like India and China, Indonesia and Vietnam, but wealthy nations like Germany, France, and the Netherlands. CO2 is getting worse. We need to have proper rules and regulations and government policy to have an effective transition to reduce CO2, keeping energy secure. We've all learned that energy supply globally is not secure, is still precarious. The United States is self-sufficient. You know, we use and produce 10 million barrels of oil a day. Many countries don't, and their sense of energy insecurity is enormous, and it is quite dangerous for them. And you see that in Germany and the war of Russia and Ukraine.
Thank you for that frank response. My time has expired, and I yield back. Thank you, Madam Chair.
Thank you very much. The gentleman from New York, Mr. Meeks, who is also the chair of the House Committee on Foreign Affairs, is now recognized for 5 minutes.
Thank you, Madam Chair. Let me address my first question to Mr. Diamond. J.P. Morgan has committed to releasing a report on its racial equity audit by the end of this year, and I think that's a critical audit. I want to focus on two aspects of your racial equity audit. J.P. Morgan has noted on its website that workforce will be included in the audit, but it simply states, and I quote, "Build a more equitable and representative workforce and hold executives accountable," unquote. Can you please explain what that entails? Where does is J.P. Morgan conducting this particular piece of the audit, and what your plans are to ensure that people of color hired at entry-level positions will be supported in achieving higher-ranking positions and able to move up the ladder?
Yeah, well, I'm extremely proud of our efforts in diversity, and I think the racial equity, the $30 billion commitment, that's what's being audited. That's $8 billion of mortgages for minorities, $12 billion of affordable housing, $500 million of small business, a lot of education, 25% of our new branches are in LMI. That's what the audit's for. There are other diversity efforts like hiring, training, recruiting, which are not part of the audit, which we do report on. So you will get to see our progress in that.
So also, well, will the audit examine J.P. Morgan's partnerships with diverse-owned asset managers and firms to build stronger portfolios? And do you have any specific goals or accountability measures currently in place?
There are, in the racial equity, the $30 billion, there are vendor efforts that are in that. There are also vendor efforts outside of that. One's being audited, one isn't, and we'd be happy to report on that too.
Look forward to having both of those reports.
Thank you.
One of the things that's extremely important to me, I wouldn't be here today, the greatest investment that takes place by the average American, but especially the largest for African Americans, is home ownership, which I believe is extremely important. Mr. Scharf, I'll just ask you this question. It has been reported that Wells Fargo, along with other banks, is looking to reduce its mortgage lending business, including in areas like FHA lending. Can you please explain the factors that Wells Fargo considered in making this decision to shrink its mortgage lending business, and how do you believe it will impact communities of color and vulnerable communities who are already struggling to access affordable mortgage programs?
Thank you, Congressman. I think it's important to, first of all, we are committed to the home lending business, and we're deeply committed to doing our part to increase black homeownership through our home lending business. But it's important to note that the mortgage market has changed dramatically. And if you were to turn the clock back probably 10 or 15 years, you would find most of the banks up here as the largest mortgage lenders in the country. That's not even close to true today. I believe we were the #1 mortgage lender in the country. We're now #6. And it's not because we have purposely de-emphasized the business. Regulations are inconsistent between banks and non-banks, and cost structures are different. And the non-banks have taken an increasingly larger share of the market as we've continued to try to focus on providing home lending products, both for our customers but in the communities that we serve. To the extent that our mortgage business does get smaller from here, I can assure you we're going to do everything that we can to ensure that we're continuing to lend to those most in need, whether they are within communities of color or those which are more racial and ethnically diverse. That's something that we're going to track, and we're very, very aware of.
So let me just emphasize how important, because I focused on closing the wealth gap. And the way you close the wealth gap, starting out, is home ownership. You know, in our area, we talk about how most markets across, owning a home is an appreciating asset. So you buy the car, you buy the house and rent the car, because one is an appreciating asset and the other is a depreciating asset. And so making sure that that opportunity continues in our communities is extremely important. And to hear that the banks are shrinking that is concerning to me. And then that opens up to where else you can get a mortgage on an equitable basis. I'm almost out of time, but Mr. Monahan, you know, I was concerned about climate change and the reporting of Scope 1 and Scope 2 emissions, and where material, I think that your comment letter said that you would support Scope 1, Scope 2, and where material Scope 3. And I'm out of time, so I'm not going to get a chance to get an answer to it, but I would like to get an answer to you back. Can you please explain what Bank of America's position is with respect to materiality of Scope 3 emissions and what the relevant safe harbors should include? Just do that in writing. I'd appreciate to see that.
The gentleman's time has expired. Thank you. The gentleman from Michigan, Mr. Huizinga, is now recognized for 5 minutes.
Thank you, Madam Chair. And so to our newbies, welcome. To our frequent flyers, Mr. Scharf, Moynihan, Diamond, and Ms. Frazier, welcome back. One more punch on the punch card, and I think you get a free cup of coffee. Interestingly enough, you've actually been here more than Gary Gensler has. I wish we would pay as much attention to the actual regulators, the folks, by the way, who we have constitutional duty to have oversight of, than those that the regulators are supposed to regulate. So Mr. Diamond and Ms. Frazier, I want to give you a very quick, brief moment. Do you comply with U.S. and international sanctions? I think that was what the implication was earlier when you were interrupted. Very quickly.
Absolutely.
Okay, Ms. Frazier?
Absolutely.
Okay. So those are U.S. and international sanctions. Got it. All right. Last time, those of you that are return members and return players, you'll remember I asked everybody what their one issue was that they thought was going to be the biggest barrier. Mr. Moynihan, you said the economy. Ms. Frazier, you touched on cybersecurity. Mr. Scharf, you hit cyber as well. Mr. Diamond, you talked about public policy. And I'd like to give you a moment to clarify that. You know, this is multifaceted, the various elements to that. But if you could just lend a little color to that, I'd appreciate it.
It'd be a pleasure. So public policy, I think America, if you look at the last 20 years, we've grown 2%. It should have been 3%. We should aspire to do more. That lack of growth has hurt, I think, household income by $15,000 or $20,000 by the end of the 20 years. It would have lifted up all of our citizens. It would have paid for a lot of programs we want. We don't strive for growth. If you look like why it wasn't 2%, which is why I was exploring public policy, it's our bad infrastructure planning. It's our inner-city school education. It's excess regulation. It's expensive health care. We have the best health care in the world. We also have the most expensive and 50 million uninsured. It's excessive litigation, which is 1% more than the rest of the world. I can go on and on and on. It's mortgages. You want to make mortgages more accessible to minorities and lower mortgages, reduce the burden of regulation. It'll bring down the cost and make it more accessible.
Amen, amen, and reclaiming my time on that. So here's as a former, long ago licensed realtor and someone whose family is still involved in housing and construction, please, for the love of everything that is holy, do not offer a 50-year mortgage. Okay, this will do nothing, absolutely nothing to build wealth or build equity. All you will be doing is having a long-term rental because you folks are going to be getting all of the interest. So that is, home ownership is the key, and I agree with my friend from New York on this, but it is not just extending payments. We have to get at the root cause of why housing is not affordable. All right, Mr. Diamond, very quickly, you said in your testimony our success and accomplishments are founded on our commitment to our shareholders, Obviously, that seems to have been shifting. I would say the Securities and Exchange Commission and others who have done an about-face on shareholder proposals with new staff guidance and those kinds of things seem to have a different take. I'm curious, how are you balancing as a shift in this? And you've got 15 seconds.
We will still focus on building the best company by serving shareholders, employees, and customers, and we'll have to navigate whatever the new SEC rules are.
All right. Mr. Rogers, we're going to touch on more on mergers. I would, by the way, posit that mergers are more because of Dodd-Frank than greed or nefarious motives. And in fact, I think Mr. Diamond, you on a shareholder call at one point said Dodd-Frank was good for your business with that and that consolidation that was going on. So, Mr. Rogers, would you agree that retail banking is a highly competitive business?
It is, yes, Representative, it's
okay.
very competitive.
And your bank, Truist, is the result of a merger in 2019, correct?
That's correct.
Okay. Do you believe that that merger allowed you to increase or decrease the accessibility to banking for your customers?
I think the mergers afforded us a great opportunity to increase accessibility and for our customers, and that was never more apparent than during the pandemic, when we were able to do $17 billion worth of loans, be the fourth largest PPP lender, do 120,000 loans and 80,000 to small businesses. We wouldn't have been able to do that with our prior scale.
All right, well, I appreciate that. I've got remaining seconds here. I do believe that the policies that we've had as a federal government, including and leading with the spending that we have done, have led the Fed to this spot where they probably need to do a 100-point basis increase, if not certainly that 75 points. Otherwise, we're going to find ourselves in a worse inflationary situation, and we have to stop the spending and get our policy house in order. With that, I yield back.
The gentleman from Georgia, Mr. Scott, who is also the chair of the House Agriculture Committee, is now recognized for 5 minutes and knows a lot about Dodd-Frank.
Thank you very much
gentleman.
for your kind remarks, Chairman. Protecting our consumers from this online fraud and theft has now become the #1 issue facing the security of our great financial system. One of the things that several of us have been working on in this committee is to bring together public and private partnerships to address this, because this technology is overwhelming. And you can see how so many of our consumers have become victims. I'm delighted to know about the public-private partnership that is going on now between FS and the Wharton School of Finance at the University of Pennsylvania over in Philadelphia. Now, Mr. Rogers, you have expressed your support for public-private sector collaborations to help us protect our customers from things like this electric payment scams. So would you mind telling us, how do you see our public bank regulators and our private sector financial institutions working together to ensure that we have federal law that will provide electronic transfer protection for our defrauded consumers in our great nation?
Thank you, Chair Scott. Thank you for leading on this very important issue of the fraud that's being experienced by all of our consumers, and it's being perpetuated by organized criminal activity, and that got exacerbated and accentuated during the pandemic. So I think we have some existing role models in cybersecurity already, where we coordinate as banking institutions and we work with our various agencies. So when something happens on a cyber case, we communicate that immediately. And I think we have that same opportunity with fraud.
Very good. Tell me exactly, how would you propose that we reimburse victims who have been scammed into initiating an electronic payment transfer? How would we reimburse?
Well, Chair, we do reimburse today. So we do reimburse for those who've been scammed, and particularly those who've been scammed with our bank's name used in particular. We're very consistent in that. But I think in addition to reimbursement, we need to be focused on eliminating the fraud and fighting the criminal activity.
Mr. Diamond, may I come to you, please? One of my biggest priorities has been reducing the number of unbanked families in our nation. What is your institution doing to get more of the unbanked population into the traditional regulated banking system?
So we have 25% of our branches in LMI neighborhoods. We have a new thing called a community branch, which is much larger. We invite in the population. We have things called community managers who walk down the street. We've got financial education seminars about mortgages, saving money, opening checking accounts. We invite the community in, tell them to come as you are, learn about these services. These seem to be working quite well. We're part of the OCC Bank On program, the REACH program, and I do think these programs are starting to actually have an effect.
And also, let me ask you this. What is your institution, J.P. Morgan Chase, what is your bank doing to overcome the mistrust that many people, one of our biggest known problems with decreasing the number of unbanked families in our nation is mistrust of traditional banks like each of yours? What is your institution doing to overcome this mistrust of large banks? And if there are any of you others who are addressing this issue, please pipe in.
I would love you to come visit some of those community branches in Harlem, South Side of Chicago, Crenshaw, New Orleans, Ward 5, Ward 6 over here, and you'll see what we're doing. Local vendors, local folks, they're all coming in. We do tens of thousands of seminars. We try to make people very comfortable. We have products specifically designed, very low fees, no overdraft and things like that. And I totally agree with you, that is part of the job.
Thank you, and I just encourage, and I really appreciate, Madam Chair Lady, this hearing.
Thank you very much. The gentleman from Oklahoma, Mr. Lucas, is now recognized for 5 minutes.
Thank you, Madam Chair, for holding this hearing, and thank you for the witnesses for appearing today. The financial institutions you all represent and the U.S. banking system at large plays a vital role in the communities by protecting savings, delivering quick and secure payments, and providing access to credit. Banks will have to help their communities, their businesses, and their consumers weather the intense economic uncertainty we're now in today. I guess my first question is, inflation remains at a 40-year high. Businesses and consumers are still grappling with commodity price swings, elevated energy prices, a tight labor market, and supply chain disruptions. U.S. real GDP declined in the first and second quarters of 2022. The Federal Reserve will again raise interest rates today, I suspect, which is designed to discourage consumption and business activity. How are you advising your customers on how to prepare for these conditions? And I'll start with you, Mr. Monahan. What are you telling your folks out there?
So I think with the amount of uncertainty, job number one is to deal with inflation. Inflation has impacts on, as my colleague said, on the people who can afford it less. And so, the impact on the mortgage market of raising rates feels not good. The reality is it needs to be done to slow down housing appreciation, because 20% per year housing appreciation is not a good thing for people to keep up with. So that's job number one. And so when we talk to our clients, it's the same thing. The Fed will raise rates to get inflation, and then as an operating entity, as a consumer, as a company, as a small business, understand what that impact is. It's going to have an impact of slowing demand. It's going to have an impact of raising your cost of debt, and you should be making sure business plans and personal plans adjust for that.
Anyone else wish to touch on that? Okay. I remember the economic suffering we endured in the early 1980s. I was in college and just beginning to farm on my own, when the Fed had to strangle, and that's the appropriate phrase, high inflation out of the economy. And I worry that the reckless policies and excessive stimulus we've seen make the Fed's job even more difficult. But turning to question number two, During a recent speech, the Fed Vice Chairman for Supervision, Michael Barr, discussed how the Federal Reserve is considering how to develop and implement risk-related scenario analysis. I worry the regulations that could begin to use climate stress tests to shape and enhance capital requirements, I worry about those, which could have negative long-term economic consequences. Climate scenario design and associated data remain considerable obstacles, as well as the high potential for politicization. Mr. Diamond, could you discuss your perspective on the argument that the Fed should tie climate risk with increased capital requirements, please?
So just for the folks here, we do 100 stress tests a week. We are quite worried about it. We always have been. We always did it. The Fed does one a year, and it's only one type. We do multiple different types. So, among the stresses we've always had were hurricanes, storms, floods, things like that. So to the extent it's real like that, I'd say yes. To the extent it's for social, public purposes, to have banks do something different on how they finance oil and gas, absolutely not. And if they did that, it would have an effect.
It does kind of come back to the old principle that banks are about collecting capital, pricing it, distributing it appropriately, and pricing it there. I think that's arbitragers. Okay. One last question. The state-owned Chinese banks continue to play a large international role, and the Chinese Communist Party is intimately involved in the banking system and have the ability to influence banks' lending activities and credit allocations. Could you discuss the challenges this creates in terms of global competition for U.S. institutions? Back to you, Mr. Diamond.
Yeah, it's a very good point. We have to compete with global Chinese banks. The four largest are now the largest in the world in terms of assets. They also operate in 50 or 60 countries, which they didn't do 20 or 30 years ago. They have less capital requirements than we do. They enjoy government support. The government wants them to succeed. And I do look at that as not today's competition, but tomorrow's competition. So all the banks here play a different role in the ecosystem, but to bank big companies and countries and things around the world, you need big banks. If you want to bank Boeing, or you have to operate in the 50 countries in which they operate and stuff like that. So I'm going to do everything in my power to make sure we can compete with the best Chinese banks in the world. It's very important to the future of America that America maintain its financial supremacy, just like almost anything else.
Thank you. And Madam Chair, I yield back the balance of my time.
Thank you very much. The gentleman from Texas, Mr. Green, who is also the chair of the Subcommittee on Oversight and Investigations, is now recognized for 5 minutes.
Thank you, Madam Chair. Madam Chair, the great Maya Angelou summarized the essence of my very existence when she proclaimed, "Bringing the gifts my ancestors gave, I am the dream and the hope of the slave." I proudly say that I am a descendant of enslaved people. Slavery existed in this country for some 246 years. The value of 246 years of unpaid slave labor has been estimated to be as much as $14.2 trillion. Let's examine for just a moment each mega bank's involvement in financing slavery. Truist Financial Corporation has assets of approximately $532 billion. 5 predecessor institutions engaged in financing slavery. PNC Financial Services Corporation, assets of approximately $534 billion. A predecessor loaned $135,000 to a railroad company that used slave labor in 1852. U.S. Bank Corp., assets of approximately $582 billion. A predecessor institution made a loan secured by enslaved people. Wells Fargo, assets of approximately $1.71 trillion. Predecessor bank accepted enslaved people as collateral in at least 24 transactions, took temporary possession of enslaved people from defaults on loans, conducted business with the Confederacy. Citicorp, assets of approximately $1.72 trillion, provided a chart of mergers pursuant to a request that we made and acquisitions over a course of 210 years that is lengthy and complex, but didn't give us a detailed report. Staff has asked for more information, hasn't received it to this date. More to be said on that at a later time. Bank of America, assets of approximately $244 trillion. A predecessor bank secured a mortgage with real and personal property. The borrower's property included 13 enslaved people. A predecessor bank agreed to a $10,000 mortgage to U.S. Secretary of State John Forsyth with 40 enslaved people as collateral. J.P. Morgan Chase, assets of approximately $3.38 trillion. Predecessor banks accepted 13,000 enslaved people as collateral for loans, came into possession of 1,250 enslaved people from defaults on loans. In the case of J.P. Morgan Chase, there has been an apology publicly made and an announcement of $5 million scholarship, which amounts to about $384.61 per enslaved person. These scholarships went to persons in Louisiana. I have a question for you, each of you. Question is this: if you believe your bank has done enough to atone for your involvement with slavery, kindly raise a hand into the air. Let the record reflect that no hand has been raised. Next question, will you publicly publish an atonement plan or on or before your next appearance before the committee? An atonement plan. You've indicated that you've not done enough. Will you publish an atonement plan on or before your next visit? If so, raise your hand. Let the record reflect that not one bank has proposed an atonement plan. Let's move to another area quickly. I don't perceive either of you to be, any of you to be a person of color. Have you self-identified as a person of color? Raise your hand. Not one person raises a hand. In the next 10 years, will there be a person of color to head your institution? If so, raise your hand. Let Truist Bank, and that is the only one, I think. Thank you. I yield back.
Thank you very much. The gentleman from Kentucky, Mr. Barr, is now recognized for 5 minutes.
Thank you, Madam Chair. Mr. Diamond, in your April letter to shareholders, you called for a new Marshall Plan to ensure energy security for the United States and our European allies who are overly dependent on Russian energy. I couldn't agree more, which is why I'm so skeptical of ESG and the weaponization of financial regulation designed to discriminate against American energy companies. It's why I oppose the imposition of European-style climate stress tests on U.S. banks, requiring banks to hold more capital when lending to fossil energy or carbon-intensive firms, and the SEC's flawed climate disclosure rule, which would politicize capital allocation, redirect capital away from American energy firms, and steer retail investors into higher fee, less diversified, and lower return ESG investments. I commend you for recognizing in your letter that, quote, national security demands energy security for ourselves and our allies overseas, and for rejecting the demands of climate alarmists who have called on you to immediately cut off financing for fossil energy firms. But my specific question relates to coal, since coal still accounts for 22% of all electricity generation in the United States. And you write in your letter that, quote, using gas to diminish coal consumption is an actionable way to reduce CO2 emissions expeditiously. Mr. Diamond, do you believe that a coal company with a strong balance sheet, little or no debt, and a demonstrable track record of creditworthiness should have equal access to conventional bank financing as a natural gas company with similar financial characteristics?
Yes.
And will your institution commit to the continued financing of American coal producers who are still needed and will be for some time to supply the most affordable and reliable source of baseload power to the American economy?
We are working with the responsible coal producers and utility companies, many of whom, by the way, are dramatically reducing the CO2 as we speak.
Mr. Moynihan, I'll spare you a similar questions, but as you and I have discussed, and notwithstanding your net zero commitment, I appreciate your focus that job number one is on addressing inflation. And to lower the rate of inflation, we cannot rely exclusively on Fed tightening. We must also address the supply side, and that means more, not less, financing of American energy exploration and production. And I urge all of the CEOs here to adopt a similarly measured approach to financing fossil energy. Mr. Moynihan, though, my question pertains to the FDIC's March request for information on the regulatory framework that applies to merger transactions involving one or more insured depository institutions. The FDIC's action signals a heightened regulatory resistance to bank mergers, presumably on the grounds that consolidation of the banking industry, which has significantly reduced the number of smaller banking organizations and increased the number of large and systemically important banking organizations, is a threat to financial stability. My question, Mr. Moynihan, is which of the following institutions is a more formidable competitor to Bank of America? Is it SunTrust operating alone? Is it BB&T operating alone? Or is it the combination of the two institutions now known as Truist?
Undoubtedly, the combination of two institutions is a more formidable competitor.
And Mr. Rogers, since I invoked the name of your institution, would you care to comment?
Well, I'm proud that Mr. Moynihan named me as a strong competitor to his business.
So I take it from the response of both of these gentlemen that an overly aggressive resistance to mergers by the FDIC could actually diminish competition at the GSIB level and therefore undermine financial stability. Final question to all of you, anyone who wants to chime in. Do you assess the impact of a CBDC as positive or negative for our economy and our credit markets? Specifically, how would a CBDC impact your deposit base and therefore your ability to deploy capital into the real economy? Mr. Diamond?
If it's properly done, it'll be fine. I don't trust it'll be properly done. You're not going to have the Federal Reserve running call centers. So there's a lot more to banking services than the actual token that moves the money. There are fraud, risk, alert, services, call centers, banks, branches, ATMs, CRA. So properly done, it's not a problem. Improperly done, you will have an issue.
Ms. Frazier, my remaining time, increased capital requirements. Vice Chair Barr suggests he wants to review this. What would that do to the ability of your customers to repair supply chains, your ability to deploy capital and fix inflation?
Given that we passed our stress test, which should be a test of whether we have sufficient capital, which is important for safety and stability, then the question becomes when you increase capital above that limit, then that can have a very detrimental effect on one's ability to lend right at the point when the capital markets are shutting down.
Thank you. I yield back.
Gentleman's time has expired. The gentleman from Missouri, Mr. Cleaver, who is also the chair of the Subcommittee on Housing, Community Development, and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair. Let me just express, some appreciation for the fact that some of you have already taken steps to make corrections as it relates to, your banking in distressed communities. As all of you probably know, in 1977, Congress passed the CRA Act, the Community Reinvestment Act, and we did so because we were concerned about banks that were using deposits, even in some distressed neighborhoods, to fund out-of-state and in some cases international lending activities at the expense of addressing the local areas. So the CRA was created, and we have not had any upgrades to the CRA since 1995, I think it is. And is there anyone of you who believes that we do not need to update the CRA Act? Well, you make me happy. Make me happier now, because I'm going to keep going toward happiness. The thing is now, are all of you interested in and willing to look at ways in which we can increase CRA, even to the extent that you can get CRA credit for housing, affordable housing in urban areas? Is anyone willing to and very, very, very interested in doing that kind of program? My jaw level is continuing to rise.
Yes.
Thank you. Thank you very much. Now, to jump over a little, the role of non-bank lenders is increased, as you all know, and we have to deal with it dramatically since our 2008 economic collapse. Non-bank lenders now originate more mortgages in the United States. It's almost 69% of all mortgages in 2020. Non-banks also originate 4 out of every 5 FHA loans, which are more likely to be originated in low and moderate income communities and borrowers. Between 2010 and 2016, the FHA share of loans originated by the 3 largest banks fell from 43% to 5%. Now, can any of you, or any of you willing to explain the retreat from FHA loans, and what are your banks doing to extend mortgages to low and moderate income borrowers? Is anyone's bank? Yes. Mr.
Go ahead, Brian.
You can go. Yeah. So, having learned our lesson in FHA VA practice, a lot of us have brought our percentages down, as you said, but we replaced it with programs that we do on our own, put on our own balance sheet, that are safe and sound for the consumer, that provide down payment assistance up to $17,000 on a loan, and that's what we did to offset it. So I wouldn't look at FHA VA as the only indicia of loans going into the communities, et cetera, but the risk of doing that business, the putback risk, the servicing, it just wasn't worth it, honestly. And so we still do 5-6% of our loans in the FHA VA program to help us with first-time home buyers, but we built programs outside where we can work with the consumer, how to approve counselors, and build great programs that will actually do more for the consumer, we believe.
Congressman, we work with FHA and have done so. We also put those loans on our own balance sheet. One of the FHA, in my view, needs revamped. Today, there is a limit because we become something called an interested party, where we are only able to contribute 6% of the proceeds of the loan, either in closing costs or in down payment assistance, by their regulation. So when we do that, if we go beyond that, we balance sheet it on our own. We don't actually participate in their program. They ought to change that.
My time is running out. I hate it is, but Madam Chair, I yield back.
Thank you very much. We will now take a brief recess and resume in 10 minutes. The committee now stands in recess.
I'll text you when I get that order.
Yeah, you guys could sit. Oh, see, people keep their. I think people put their stuff there to reserve their seats. I just don't know. There's a bag underneath the bed.
Oh, there he is.
That's what there's. Okay. Yeah. Or you could sit and those have all the.
I think sit here and you get me.
Yes, sir.
identify all these people out here in your district. Yeah. Yeah. But this is how it's run. This is government. Yeah, this is one of the bigger ones. Yeah, these are all the bank CEOs. So Jamie Dimon, JP Morgan CEO, who likes to be very helpful on things. He's here, so that's why these cameras are for. They're having to explain. Thank you. Yeah, not a problem. It's inside baseball. Yeah. That's why all those people behind them, all the different people, those are all like their equivalent of me. That's all the staff for the CEOs. So they're did ask a question. I'm gonna watch the video when you get back to the office. And then look at the guy. They call us racist. They call us racist. They call us socialist. Racist. Not they don't call us socialist. Yeah, white supremacists, fascists. Okay. I'm fast. Till people come back.
The committee will come to order. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Madam Chair, and welcome back, witnesses, ladies and gentlemen. I'd like to focus on a larger issue today that affects every U.S. consumer and consumers all over the world, which is heavy investment in volatile and unfriendly countries such as Russia and China. Ms. Fraser, Mr. Diamond, and Mr. Moynihan, each of your banks had significant investments in Russia, which you drew down after Putin's invasion of Ukraine. While American sanctions were an impetus for those actions, it should be said you did the right thing by shrinking your assets there. We learned two important lessons during the period. Number one, there's a large risk in investing in volatile nations with dictatorial governments. And number two, your investments play a significant role in supporting those nations' economies. In recent months, China has continually threatened our ally Taiwan with military exercises and violent rhetoric. Should the CCP follow through on its threat to invade Taiwan,
what you want us to do?
I appreciate your willingness to follow U.S. law, and your banks have made statements of business decisions that go well beyond you. But you've made decisions that go well beyond U.S. law and enter the realm of moral judgments. For example, in 2018, Citi and Bank of America announced lending restrictions to certain gun manufacturers and retailers. In 2019, J.P. Morgan publicly announced it will not fund private prisons. None of these decisions were made because of a law passed by Congress. Mr. Diamond, would an invasion of an American ally be enough for J.P. Morgan to make the moral determination to stop doing business with the Chinese?
Missed the question?
I say, if an invasion of an American ally would be enough for J.P. Morgan to make the moral determination to stop doing business with the Chinese Communist Party?
We'll have to decide when that happens.
You're not going to commit to pulling assets out of China if they invade Taiwan? That's what you just said.
The first thing I would do is call the American government and ask for guidance. That's what I would do. That's what they would expect me to do.
Mr. Moynihan and Ms. Fraser.
It'd be the same in terms of decision, but we always look at clients and risk. And in fact, you'd find that before the Russia situation took place in Ukraine, we made adjustments to our risk, and we do that all the time in every country that is volatile, irrespective of.
Ms. Fraser?
Clearly, it would be driven by the government. In the occasion you're talking about, that would be driven by the government rules and regulations and laws and Congress's desire.
Ms. Fraser?
Similar to both of Mr. Diamond and Mr. Moynihan, the first call would be to the U.S. government to understand what they would be expecting and wanting us to do in the time frames to do so.
Suppose the government said it's up to you to make your own decision. It's a business decision on your part. What would you say?
It's highly likely that we would have a materially reduced presence, if any at all, in the country.
So if the business decision were left up to you, you would pull out probably.
It's
or reduce some assets.
It's a hypothetical question, but it is highly likely that we would have a reduced presence.
Okay. Each of your banks have published statements pledging your commitment to supporting and protecting human rights around the globe. According to the State Department's 2021 report, genocide and crimes against humanity occurred in China last year. Those crimes include arbitrary and unlawful killings by the government, arbitrary imprisonment, forced sterilization, rape, and torture of a large number of those arbitrarily detained. Mr. Moynihan, do you condemn the Chinese Communist Party for those horrible acts that they regularly carry out?
We look at any client we do business with to their operations in any matter, and we make that decision. So the governmental condemnation isn't the important thing of who we do business with China. It's actually the company that we underwrite. It's client selection, as we call it, sir.
Would you explain that again? I missed that. I'm sorry.
I think the question is, when we look at what we do in a country, it's individual clients. It's not a theoretical concept. So we look at that client, if that client's...
Mr. Moynihan, with all due respect, the government of China is the Communist Party. The Communist Party of China is the government. If you're doing business in that country, you're doing it willingly with respect to them allowing you to be there. And you're doing it under their laws, which the last time you were here, one of you three actually made that comment. So if they're committing these atrocities, are you okay with that? Are you willing to continue to do business with people who are committing these kind of atrocities? Whenever you say in other statements that that's a bad deal.
We don't do business with companies that we believe are doing atrocities or something like that. You're asking a hypothetical
You're
question.
doing it
about
under the
somebody-
protection and auspices of this government. That's my point. Ms. Frazier?
We obviously take any accusations of human rights abuses very, very seriously. Similar to Mr. Moynihan, we do not do any activity with companies that are involved, forced labor.
But it's okay to do business
or
with the
like.
government,
We do business with the government,
even though they
not.
commit those atrocities. Thank you. I yield back.
The gentleman from Colorado, Mr. Perlmutter, who is also the chair of the Subcommittee on Consumer Protection and Financial Institutions, is now recognized for 5 minutes.
Thanks, Madam Chair. Mine are going to be a little simpler than that. Mr. Moynihan, Bank of America has some of the best economists in the world working for it. I've had a chance to meet with a couple of them. And I guess I'm coming at things a little differently than have been expressed by my Republican colleagues and some of you. Looking at the last few months, from May on, prices have held steady or dropped. The University of Michigan anticipates prices to drop over the course of the next year. So in conversations with your economists, what do they predict? What do they think is going to happen?
Our economists have this quarter, third quarter of 2022 is a positive GDP, negative for the fourth quarter of this year, negative for the first quarter of next year, and I think negative for the second quarter of next year, and then moving positive and ending up at a 2% year-over-year growth rate in the fourth quarter of 22. That's the estimates they have.
No, thank you. And you know, I dealt with them at the beginning of COVID. I don't know if you recall, just to kind of get their analysis, what they expected COVID to do to the economy if we did nothing, if we just, you know, held steady, everything went, we didn't do PPP, we didn't do unemployment, we didn't do any of that, and they said, well, then we're going to have trouble. And, you know, thank goodness, from my point of view, we did a lot to keep the economy moving. And, you know, obviously there's a year-over-year increase in prices, but if we go forward on an annualized basis, just based on August, it's 1.2% for the next year. And if you look at the whole summer, it's less than that. So what I'm worried about is an overreaction by the Federal Reserve. And the last time we saw them increase interest rates like this was back in the 80s and early 90s. And I can tell you, Colorado got clobbered. Housing market just stopped, as did everything else. And so, Mr. Demchak, I'm going to turn to you because PNC had a pretty good-sized subsidiary called the Kissel Company back in those days. I don't know if you're familiar with it, but it suffered a lot of foreclosures back in the 80s and 90s, as did some predecessors to U.S. Bank, and certainly J.P. Morgan. Citi had the same issues. So what do you see? What does your bank see on the horizon in terms of foreclosures? If Mr. Diamond is correct and we get this, you know, we get hit hard because of Ukraine and this and that, I mean, I think most of what we're facing is supply chain disruptions caused by COVID, and that's why we've seen some prices go up. But are you prepared? Is your bank prepared to handle a lot of foreclosures if the bottom falls out as is potential problem here?
Thank you for the question. You know, I would suggest that I think inflation is going to be a little bit stickier than we would like. And I think as a result of that, interest rates are going to be a little bit higher than we would like for longer than we would like. The impact of that on housing is clearly already felt in the creation of new homes and the sale of homes. The impact of that on existing homeowners and LMI communities and their inability to make payments as a function of inflation absorbing a greater percentage of their income is a real issue. We work with government-funded programs, state-funded programs, PNC-funded programs to make sure people stay in their homes.
So have you seen delinquencies rise?
We have not.
You have not seen delinquencies?
Not at this point.
Have any of the banks seen delinquency rise or rising on home mortgages? Nope. Mr. Diamond and I have disagreed over the years on the amount of capital that should be retained. And part of this comes, my dad was on a bank board of a predecessor bank to U.S. Bank, and he was operating under an MOU during those years when the Fed took the interest rate up dramatically back in the 80s and early 90s. So, Mr. Diamond, if you get your worst-case scenario that you kind of outlined, is J.P. Morgan capitalized to take, such an economy?
Absolutely.
Everybody else feel you're well capitalized?
Yes.
Yes.
Wells Fargo? Truist?
Yes.
Even if Mr. Diamond's worst predictions come, he didn't make a prediction. He was just saying it's a possibility.
I think our stress tests are beyond Mr. Diamond's predictions.
Bank of America?
Yes, you don't have to take our word for it. Look at the stress tests for 10 years in a row. They've been stress testing under scenarios that have the worst indicator of every element that's occurred. So the highest residential real estate prices, the highest commercial real estate prices, the highest unemployment, the highest stock market, and
Thank you.
Look at the results.
I have to yield back. Turn back to the chair.
Thank you. The gentleman from Texas, Mr. Williams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank all of you for being here today. Appreciate it. Last week, a new merchant category code was approved for gun and ammunition sellers. My Republican colleagues and I have expressed concerns that this will make it easier to track, expose, and limit the constitutional rights of millions of law-abiding gun owners. Progressives are already cheering that this will be a huge step forward in monitoring suspicious gun purchases. After the left claimed victory, Visa came out with a statement about how they have been dragged into the political arena, and it reads, "We do not believe private companies should serve as moral arbitrators. Asking private companies to decide what legal products or services can or cannot be bought. Further, it would be an invasion of consumers' privacy for banks and payment networks to know each of our most personal purchasing habits. Visa is firmly against this." So even though I think the credit card companies should disregard the new code, I do agree with the statement released by Visa. The problem with these new classification codes is that determining what is suspicious is a subjective exercise, and anyone who is against the rights of gun owners will want your institutions to flag every single transaction with the gun MCC to law enforcement. So before I continue, I want to quickly get a yes or no answer from each of you on two things. First, if you agree with implementing this new MCC for guns, and second, if you agree with the Visa's public statement. We can start with you, Mr. Sharp.
Can you just please repeat Visa's public statement?
Read the public statement that I just read?
Yes, can you just repeat it? I didn't follow it.
Well, well, I can read it, but it's going to cut into our time. It just says they don't need to be in the political business, and they, want to get out of it. So
to answer your question, we don't set the merchant category codes. So the ISO Association sets them, and we're instructed to follow them. And so what we think is not really relevant at this point.
Okay, Mr. Rogers.
We'll certainly follow the rules set by the credit card companies and the intermediaries, but we'll also abide the law for bank privacy and privacy of our clients.
You agree with Visa's public statement?
We'll protect the privacy of our clients according to the law.
Mr. Moynihan?
As my two colleagues have said, that the rules of the association, the rules of ISO, it's not our doing. We just have to implement them. But we believe in the privacy of our customer data, and we've held that true for many years. I'm not sure I agree with Visa's public statement at all, but it's their statement. I'm not sure I don't agree with it. I just really don't reflect on other people's statements, frankly.
Ms. Frazier?
Similar to Mr. Moynihan, I can only speak for our own bank. We do not intend to use the code to limit sales of firearms for our individual cardholders.
You said you do not?
We do not intend to limit the purchase of firearms by our individual cardholders as a result of the code.
Mr. Diamond?
We actually don't know what they use it for. and we don't want to be in the business of telling American citizens what they can do with their money. We understand your concerns over the issue.
Okay. Next. Yeah, next.
Mr. Dem Chair, I have nothing new to add. I think everybody's covered it.
Okay.
Consistent, we will abide by the rules and protect the privacy of the customers.
Thanks for those answers. Ms. Frazier, what are the criteria that Citibank will use when determining if they should flag a suspicious transaction with this new code?
We will follow the regulatory requirements in terms of the filing SARs, as we always do, but it's first blush at looking at this. We don't think it'll be a factor in filing a SAR.
Okay. Mr. Monahan, on a similar note, how would Bank of America determine if a customer's first-time gun purchase warrants a SAR filing, or is it just someone who recently became interested in hunting?
Again, as my colleagues have said, if they purchase a gun at a shop, the fact that they purchased it has nothing to do with a SAR filing.
My last question real quick. When I talk to business owners in Texas, where I'm from, there doesn't seem to be any debate that we're in a recession or not, and they're concerned about it. And I'll be quick with this question, Mr. Diamond. Earlier this summer, you said that you believe there's a strong possibility of recession and 20 to 30% chance of something much worse. Can you describe the economic hurricane that we could be seeing if you think we can avoid further economic damage?
Yeah, just that strong American economy, strong consumer being offset by high rates, stagflation, inflation, war, QT, which we've never had before, and those are meeting as we speak, and they will meet for the next 6 or 9 months. We don't know the outcome.
Thank you. Thank you. I'll lean back.
Thank you. The gentleman from Connecticut, Mr. Himes, who is also the chair of the Subcommittee on National Security, International Development, and Monetary Policy, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you all for being here. I first sat in this room in the first quarter of 2009 when the economy was contracting at an annualized rate of 10%, and I really did worry that a number of your institutions weren't going to survive the week. We have come a long way. Mr. Diamond, thank you for acknowledging, I think you said credit where credit is due, that Dodd-Frank was a big part of that. I was assured at the time by people on my side of the aisle that Dodd-Frank would crumble like a sandcastle in a hurricane. I was assured by my friends on the other side of the aisle that it would obliterate the banking sector. None of those things proved anywhere close to being correct. Credit where credit is due. We got through the mother of all stress tests in these last 2 years because of Dodd-Frank, but also because of your stewardship of the institutions that you run, and thank you for that, not just for not creating systemic problems, but for actually getting the PPP, which was so important to so many businesses in my district. I say all that just because I will forever focus on risk, and I have 3 questions about risk in 4 minutes. Mr. Diamond, 70% plus of the mortgage origination market has migrated outside of a banking environment. We've got a lot less visibility. Take a minute to talk about whether we should be focused on that risk. Mr. Moynihan, I'm going to ask you in a minute or so for non-obvious risks that Mr. Diamond doesn't cover. And then, Ms. Fraser, I'm going to close with you with a minute on, because of your global footprint, what risks are out there that we may not have jurisdiction over, whether it's Asia or Europe, that could get transmitted into our system here. Mr. Diamond, the mortgage origination market.
Yeah, I wouldn't call it systemic risk. It is riskier because the smaller companies cannot finance and advance funds to securitizations when there's a crisis. We could, and that we do need to reform it for the sake of the industry so that people can get mortgages at all times.
Mr. Moynihan, what risks are we not thinking about? What's the bullet we're not seeing right now?
Are you talking about in the mortgage business?
No. Generally.
I think
inside or outside of the banking sector. Sometimes I worry just as much about what's happening outside of the banking sector than what's happening inside.
I think when you think about the economy and where it goes to create risk versus in leverage, and honestly, there's more of that outside the banking system than inside, and that's something I think the FSOC and others should be carefully watching now in terms of funds, private lending funds that have leverage in them, private lending funds that lend at high leverage multiples. Our industry, because of the examination practices and frankly the way the companies are run, does not participate in them. So that's where I'd say a risk is, but it's always going to be about the economy and the demand.
So let me ask you to be just a little bit more specific there. When you say private lending funds, are we talking about CLOs? Are we talking about the high yield market? What are you talking about, and what should we be focused on?
It'd be all of them. In other words, that the amount of private credit, not only in mortgage, but every single asset class, more than half of it sitting outside our industry. And if you look at where the leverage multiples an individual deal get done, they tend to get done outside our industry at higher multiples due to the regulatory.
Okay, and I think you've all said this morning that you feel like your institutions are either adequately capitalized or perhaps overcapitalized. So are you saying that there are private non-banks that are undercapitalized relative to the lending they're doing?
Yes, but they'll have net asset value. In other words, their liabilities are interest in those funds that we mark to market, so you won't have the same kind of stress, but the impact on the economy of liquidating those companies by people who don't work the same way the banking system works for their companies could cause more damage than if we build reserves, we work out companies. This is what we've done for hundreds of years, literally. Other people don't have the staff to do that, so therefore they just sell them, and the liquidation process can cause more ongoing damage to the economy.
Okay, thank you. Ms. Fraser, let me close with you. Again, we have jurisdiction over some stuff, but not over lots of stuff. So what do we need to be wary of internationally?
When we look internationally, I think that what's happened from the pandemic and the war is it's highlighted a lot of fragility in the global economy. And therefore, we have to increase our concern around energy security, food security, cyber security, which will not necessarily all have an impact in the US, but there could well be spillover effects. So for example, in Europe, the supply shocks in the energy market that they're facing could well be a factor affecting the US economy next year as demand slows and they enter a highly likely recession. So the interdependencies and these fragilities are going to be the pieces we have to keep an eye on.
So connect that for me. So you identified energy and food. What's the mechanism of transmission? I get the economy if there's an economic slowdown, but what's the mechanism of transmission in which by global energy or food markets actually create a prudential problem for you?
It could result in, if there's a material energy shock, you could see it'll continue in Europe, you could see industrial production shutting down this winter, you could see people who are cold, and that can have different discontent from their populations, and that could then translate into lower demand, and therefore lower demand for American goods and services, and impacts into the US economy. So that's where the main mechanism would come from.
Thank you. Thank you. My time's expired. Thank you, Madam Chair.
Thank you very much. The gentleman from Arkansas, Mr. Hill, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for all of you taking away from your day jobs to spend today with us. And glad to know you had a comfort break a few minutes ago. That was kind of you, Madam Chair. Thank you. And hope each of you got a little cup of water and a cracker maybe to go with that. Good discussion. I thought Mr. Lucas raised the discussion quite well on climate stress testing. I saw where Mr. Barr, our new Vice Chairman of the Fed, thinks this is a priority, and some of you are complying with that in Europe, are you not? Mrs. Fraser, are you complying with a, quote, climate stress test over with your operations in Europe?
Yes, we have had to conduct those in compliance with the legal requirements.
What do you think that cost the company pre-tax to do that?
I would have to get back to you with a number. I don't know.
Send me, if you don't mind, if you'd respond in writing on that.
Will do.
And you've just all passed the stress test that the Fed imposed, and in that analysis of sharp declines in unemployment and sharp failures in performing assets, when you look at those performing assets, you take climate into account, right? When you make a loan to build a tower on Miami Beach, Mr. Moynihan, do you not do that?
Sure. Leave aside the stress tests, you have to take into account the risk and the project, the borrower, the person. Of course we do.
Right, so Mr. Caston has a bill that he's introduced here for the majority, H.R. 3571, that would require climate stress testing and would add capital requirements to anyone who fails that stress test based on a panel of scientific experts advising the Fed. Is this a good idea? Who would like to answer that question? I'll be happy to call on Ms. Fraser again. Is that a good idea? You like that idea?
The challenge with that idea at the moment is we just don't have the data.
Right. It's not comparable, is it? These proposals are not comparable within an industry or between industries. Is that a fair statement, what I read in the Financial Action Task, the Financial Disclosure Task Force? Yeah, the record shows they're nodding. Mr. Moynihan, privacy, you comply with the European GDPR privacy rules. Is that correct? Bank of America's operations in Europe?
Yes, we do.
And you are a big bank in California, so you comply with California's privacy law, right?
We have to, obviously.
And you do, I'm sure, a magnificent job there. Do you think we need a federal preemption and a federal privacy law? Will that aid the financial services industry generally?
I think the financial services industry has had 30 years of privacy regulation that the other industries haven't, and I think we do a pretty good job of it. We're examined on it. Very different from other industries have an ongoing examination process. So I think, and frankly, we are exempted from some of those rules because of that long history.
So Gramm-Leach-Bliley is pretty powerful for privacy.
Yes, sir.
So I hope, Madam Chair, maybe in the next Congress, we can work with the Energy and Commerce Committee, make sure we're all on the same page on privacy. Mr. Sheriff, Wells Fargo, you made some good comments about mortgage banking, and there was comments today that mortgage banking has shifted to the non-bank sector. Think regulation had anything to do with that?
Congressman, I did say that there is a difference between the way banks and non-banks are regulated, and there's no question that that degree of regulation will impact your cost base, what you want to do inside your company.
So when Dodd-Frank said that banks and banks holding companies couldn't do mortgage servicing rights, was that a bad provision in Dodd-Frank?
Congressman, I'm not aware of that provision.
So it caused all of you to divest your mortgage servicing portfolios, even though you're the largest 1 to 4 family mortgage lenders in the country. So you had a natural hedge, but after the financial crisis, all of you were asked to lower that so you wouldn't be charged a capital surcharge on that. Was that a good idea or not? Anybody else want to respond to that?
Congressman, I'll just keep going. We still have a large mortgage servicing asset.
But you can't grow it.
The capital requirements are very specific on it, but it's up to us to determine how much of our capital we choose to put into
Okay, thank you.
versus something else.
You have more on that if you'd follow up. Mr. Diamond, the Fed has a dual mandate, price stability and growth of the economy, and we've had a proposal by the majority here to add equity to the Fed's mandate. Should the Fed focus on its price stability mandate?
In my opinion, yes.
And Mr. Kaiser at U.S. Bank, can you write a memo persuasively that you should have a living will, or do you think that's not necessary for a bank your size?
We have a living will and a resolution plan that has been reviewed by the FDIC for the past 10 years.
And do you think the Fed should just leave it at that, or should they impose something different?
I think it's been successful, and we have a very simple operation. 99% of our bank is within the holding company, and there's no...
Thank you very much. I yield back, Madam Chair. Thank you.
Thank you. The gentleman from Illinois, Mr. Foster, who is also the chair of the Task Force on Artificial Intelligence, is now recognized for 5 minutes.
Thank you, Madam Chair. I'll just like to touch briefly again on regulatory capital levels. You know, I'm amazed at how consistent that your industry is. When you come to us, it is almost always with some elaborate set of logic to try to convince us that you should be allowed to lever up more. And it's interesting because if you, if you've probably all been forced to learn all about the Mogliani-Miller theorem that says the return on equity is independent of capital structure and in particular independent of leverage. And so why is it that you are always demanding higher levels of leverage? And I think part of the answer was well analyzed at the end of the financial crisis, that you all benefit from having the federal government and the federal taxpayer as the insurer of last resort. You know, if under an extreme disaster, if one of the cities you do business with gets nuked, you're all insolvent, and you will be bailed out by the government, and that's okay. But the question is how far out on the tail the government should assume that risk. And so the game that you will always be in is trying to allow you to lever up and expose the taxpayer to that risk. And our job will always be to push back against that and demand enough levels of regulatory capital that it's very unlikely that the taxpayer will be called upon to do that. And so, just a quick question there. Do any of you believe that the higher regulatory capital levels of Dodd-Frank have prevented you from having an extraordinarily profitable decade? The records show that no one has indicated such. So I think that's a very significant conclusion from the whole debate here. And I'd like to spend some time talking about secure digital ID and know your customer requirements. Mr. Demchak spoke eloquently about the difficulties of dealing with financial fraud, and a lot of that is 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 identity fraud. Mr. Moynihan had a very unpleasant experience with the failure of the federal government or state governments to have any kind of secure, reliable way of authenticating you are who you say you are online, and exposing you to very high levels of fraud and having to do something quick and dirty and unfortunate in trying to fix that. This experience wasn't shared in countries where they had a secure way of, secure and reliable way of proving you are who you say you are online. And the EU, most all of you do business internationally, and you're probably aware the EU has a very comprehensive roadmap for a secure digital ID that would allow you to, if you want to open a bank account, you walk into a branch, you get out your cell phone, you say, okay, you get your passport or whatever it is, or your real ID compliant driver's license if it's in the US that's on your cell phone. Convince your cell phone that it's really you and someone hasn't stolen your cell phone, and with a pretty quick interaction, have a very secure way of proving that you are a single legally traceable person. And there is a roadmap that's actually being rolled out by a number of states. Ironically, the technical standards behind those were all developed by NIST in the United States, now adopted by ISO and now being used in Europe. There are countries that you do business in, like Korea, where this is a reality today, that you can prove you use modern technology, use your cell phone effectively like a security dongle. So what is your stance on this? What are the differences you see in the different countries that you operate, some of which have secure digital ID, some of which are moving toward it? And what is your feeling of where the United States should be going on this? Mr. Demchak, we'll start with you.
Thank you for the question and for the thought that you've clearly put into this. It is a big problem in our country, and I think we should move towards a digital ID. It's something that the banking industry is actually working towards today with a product called Testify, where once you authenticate yourself with one bank, we can share that ID in any other service that you might want to use electronically. We have to get this sorted. Fraud is a massive problem, and our methods, our historical ways to deal with this aren't working.
Yeah. And that's a very noble approach to deal with a serious problem, but I think that there is ultimately a real government function in issuing that, that authentication. And we have that in the real ID. We have that for physical ID, and there are standards that are being deployed in individual states. So I'd just like to end with a shout out to the Better Digital Identity, Improving Digital Identity Act that we now have moving in both the House and the Senate. It was marked up in OGR. Senators Loomis and Kirsten Gillibrand are behind it. And if we can get this across the finish line, at least on the government level, we will hopefully have something to avoid the nightmare that Mr. Moynihan's bank went through, and at least have the government given a way to have citizens authenticate themselves. Thank you. Yield back.
Thank you. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Madam Chairman, thank you very much. And to the panel that's in front of us, thank you for taking time to be here. Mr. Diamond, good to see you again. The opportunity that I think you have today has shown some light about how complex your businesses are. The varying attacks against you, the things that have happened to our country economically, the changes that are going on, your ability to work with industry and others who are needing capital, needing reassurance from you, your employees who during the pandemic did not close down their chance to go to work. Maybe some of you had different restrictions based upon where you live, but your employees went to work. People kept the business running. There was not a run on the bank. There was thoughtfulness that went on by each of you in your own way. The trillions of dollars that flowed through systems that you had to take and understand who your customers were and are. We're going through instances of monetary and fiscal policy changes too. We are watching with great cautiousness about what is going to happen next. But I want to take this time and tell you that I'm impressed. I'm glad we've got big banks. I'm glad we've got stable people. I'm glad we have professionals that get up and go to work, take care of the free enterprise system, take care of large companies and small companies. I'm from Waco, Texas. Many of you are in Waco, Texas. It's now a destination of choice where people are moving. You're even opening up wealth offices there because people with money are moving there. But I want to thank you because we need to hear from you as we're hearing today, and there are some specific questions. Mr. Foster had some questions, others do. But we really look to you to be the capitalist leaders of our country. We look to you to stand for America. And I know certainly Citi and other people have done business in China for decades. You see things, you see a bigger viewpoint than we do. So I want, when you get in your car and leave today, I want you to feel like there are people that respect you. There are people that know you're in a tough place. There are people that know you're having trouble getting people to not just come to work, but to learn the business. I appreciate you. I appreciate the hard work that you do. I know that what you do is picked at and looked at in different ways and second guessed. Mr. Diamond, I know you've been the object of some challenges, and each of you have in your own way. But please know that we need you, that we should not run you out of business. We should not be onerous on what we do to you. We should give you the latitude. But you showing up today, to me, is an example of what kind of professionals you are, what kind of men and women in the organizations that you represent, that represent you, that will be there tomorrow, that do care about the challenges. And so we need to hear from you again. I hope you'll come back next year, and instead of putting us on the witness side, we'll put you on the witness side, but you'll really tell us, here's the way we see the world, and here's what we need to be the leading edge, continued supporter of the dollar. And here are the things that we need to hear from you. So I appreciate each of you. I want to thank the gentlewoman, the young chairwoman of our committee. I want to thank the gentleman from Arkansas for sitting in. But I want you to go back today, and I want you to know that we need you, that you are the basis of how our nation can operate, and that we have so many other people in the financial services industry that are there because we need them too. So, no questions, but a big thank you. I hope you'll go back and tell your employees that you appreciate them just like I do my employees at a time when America needs them the most. I yield back my time.
Thank you very much. I thank the elderly gentleman for his participation. The gentlewoman from Iowa, Ms. Axney, who is also the Vice Chair of the Subcommittee on Housing, Community and Development and Insurance, is now recognized for 5 minutes.
Thank you, Madam Chair, and guaranteed I'll be asking some questions here, so get ready. Really appreciate all of you being here. Of course, it's nice to see you. But Mr. Scharf, you know I'm going to be concentrating on you today. As you were here, just about March of last year, I believe. Now you've been on that role for a period of time, so it's good to hear we're going to be able to have a good conversation here. So I want to focus on the 13,000 Wells Fargo employees in our district. We spoke here last year, as you mentioned. You said that you were going to make those folks a priority. We talked a little bit about some of the organizational structural pieces you were going to put in place and the ways you were going to engage employees. And I was very excited to hear about those. But this news is very disconcerting at this time. There have been 9 rounds of layoffs notices to more than 350 Iowans since April. From what I understand, that's due to a slow mortgage industry. Is that correct?
I believe that is correct, Congressman,
Okay.
yes.
Thank you. And now last month, Bloomberg reported that Wells Fargo is planning a major retreat from its mortgage business, which, boy, I do not like the sound of those words. Those mortgage operations are, of course, one of the primary businesses in Iowa, And can you confirm whether that story is accurate? And can you discuss what will happen with the 13,000 Iowans that Wells employs if you shrink mortgage operations?
Congresswoman, first of all, as we've discussed, Iowa, Des Moines specifically, is a very, very important location for us. It has been for a long time, and I see that continuing to be the case for a long time to come. I don't see that changing. We do operate within businesses that are susceptible to market conditions. Volumes go up and volumes go down. The changes that we've seen in the mortgage business are the most significant changes we've seen in the shortest amount of time, given the move in rates. And so we, like all other mortgage companies, have had to take a look at our own infrastructure and ensure that it's sized properly. The first thing we do is we do try and figure out, are there other roles inside the company that impacted employees can play? And I know that we have moved a significant number of employees from one division to another as we've gone through these changes in the mortgage business. The other thing I should just point out is the mortgage, Des Moines began, I should say began, when I think when we acquired a company that was in Des Moines way back, it was a mortgage business. And for quite a number of years, the only thing that we had in Des Moines was mortgage. That's not true today. We have pieces of large parts of the company that reside there. And so if you live there and you want a role elsewhere, it's quite likely that you'll be able to stay in Des Moines and play that other role.
Well, that's good to hear. You still haven't answered the question. Can you confirm whether that is accurate, that you will be seeing a major retreat from the mortgage business?
Congresswoman, we have...
Yes or no?
Well, I don't know.
Is it accurate?
I don't know how to define what a major retreat is.
Is Bloomberg correct when they said you're planning a major retreat out of the mortgage business? This is a real easy question.
No, it's, Congressman,
yes or no?
The mortgage market is substantially lower today than it was, and so we are significantly
Okay, so I'm not getting an answer. What I did think I heard from you is that with the 13,000 Iowans, if I'm hearing you correctly, you will do everything in your possible power to find another job for them within the other parts of Wells Fargo that are located in Iowa. Is that correct?
Congressman, that is something that we do across the whole country, not just within Iowa.
Okay, so we're going to have to follow up on this because I'm still not getting a straight answer on what's going to happen to the tons of people in our district that you won't answer this question about what's happening. And what I don't want to see is all of a sudden we wake up and in the Des Moines Register, I've got 1,000 people lining up to make sure that they can get unemployment. And the other thing I want to make sure that we do is address TAA if there's going to be any conversation around moving jobs out of this country, okay? So we'll be in touch with you about that. Next, I just want to move on a bit, and this was good to hear. I saw some stories suggesting Wells would cover travel expenses for employees seeking abortion care. Now that our Iowa Governor Reynolds is attempting to push her ban through that she pushed through last time and was shot down, but she will now because of Roe v. Wade, can you confirm if Wells is covering those expenses and how that will work for the workers?
Congresswoman, we are going to, we have changed our plans so that abortion is consistent with other health care options, so that we will pay for the expenses of someone to cross state lines to get a legal procedure. And we've not worked out specifically, to my knowledge, exactly how that will work, but we can certainly share that with you.
Thank you. And one last question. Can you clarify if your commitment to remaining neutral and not interfering with employees on unionizing will be upheld?
You want me to answer that? Time is up.
Gentlelady's time has expired.
Would he be able to answer that, Madam Chair?
We're going to continue with the rules that we have used all day.
Thank you. I'll follow up on that.
I wish for him to get back to you with an answer to your question. The gentleman from Georgia, Mr. Laudermilk, is now recognized for 5 minutes.
Thank you, Madam Chair. Thank you all for being here. I know that you have been anticipating and looking forward to this day for quite a while, so we do thank you for taking time to be here. One of the issues that is paramount to me, and I think it is to a lot of people, cybersecurity. Especially as we move more into a digital age, it becomes more and more imperative that we protect data, especially data of citizens, your customers. I come from an intelligence background in the military where I had a very high security clearance. We had one principle that we live by, which is the best, that if you don't need data, don't keep it, because you only have to protect what you have. So if you don't absolutely need information, then you were to dispose of it. Part of my concern is the amount of data that you are required not only to keep, to pass on to the federal government, which, from what we have learned, becomes the weak link in the cybersecurity protection chain. And that's a discussion for another day, whether it's revisions of the BSA and CTRs and SARs and the massive amount of data that is passed along that you're required to give to the federal government, which the majority of it is never looked at, becomes a cybersecurity issue. But at the last several hearings that we've had with you and the CEOs of large banks, I've been one of the few members, if not the only, to bring up cybersecurity. And the reason I bring this up is not just with my interest, but I'm hearing from you that that is one of your top issues and concerns. Mr. Ciceri, can you give us an update on cybersecurity threats in the banking industry that you're facing and maybe some things you're doing to address those?
Certainly, Representative, and I agree that cyber is one of the significant risks that we are all facing. I will also say that we're all working very well together. If we see a node that was attacking one of us, we make sure that we communicate with each other to make sure we're shutting it down as quickly as possible. I know that we've all, including U.S. Bank, have made significant investments in cybersecurity, both from a personnel standpoint as well as an investment standpoint. We've doubled the staff in the last 2 years within our cyber group, as well as the investment in spend. The reason for that is because it is such a significant risk, and I think it requires coordination among the banks, the regulators, and the government, and we're working hard on it.
Okay, thank you. Mr. Rogers, I know that this is an area of concern for Truist, and I may interject that that is the name of the home park of the World Series Atlanta Braves. So, but that aside, I know that cybersecurity is a serious concern for Truist as well. Can you discuss the threats that you're seeing and what Truist is doing?
Thank you for your focus on this, Representative, and I can add now playoff-bound Atlanta Braves, just to add to that distinction. It has been a big focus, and it was one of the reasons we merged, was to create additional capacity to invest in things that are relevant for our clients, relevant for our communities, but also in the protection of the important data that we preserve for our clients. So we have multiple thresholds that we analyze every day related to cyber. We hire third parties to come in and test and actually try to invade us at any particular time and test our particular forces. We participate in all the industry things, including horizontal reviews by our regulators who are constantly looking at where we are relative to cyber. So we have and we've had the capability to bring in talent and capacity that's exceeded what we could do before the merger. So cyber is clearly a focus for us, and one of the reasons we merged was to create a stronger shield for our clients.
Well, thank you on that. And while I've got you, one of the things that Republicans have been working on, and we're currently accepting feedback on a draft bill that would finally establish a national consumer data privacy standard. We have to identify positively what data belongs to the consumer, what data belongs to the financial institution, et cetera, and protect that. Mr. Rogers, can you discuss why a national data privacy standard would help provide consumers with clarity about who owns their data as well as those privacy issues?
Representative, I'm not familiar exactly with all the intricacies of that particular bill, but the important part of data being owned by the client is critical. And that's how we approach data, is it's the client's data, not ours. It's our duty to protect the client's data.
All right. Thank you, Madam Chair. I yield back.
Thank you. The gentlewoman from Ohio, Mrs. Beatty, who is also the chair of the Subcommittee on Diversity and Inclusion, is now recognized for 5 minutes.
First of all, let me say thank you, Madam Chair, not only for this committee hearing, but for entrusting in me to chair the Diversity and Inclusion Subcommittee. Let me say thank you to all of the witnesses, faces that I know. But for the record, my comments and questions are not divisive, nor are they a part of any political elections coming up. And I can clearly say that because anyone who has followed me, met with me, or known me, using your words, I find myself to be the guardian of Dodd-Frank, especially Section 342, as well as diversity and inclusion, MDIs, especially coupled twin protege banks, equity for those who are unbanked, racial disparity, the wealth gap, narrowing it, looking at CRA and external contracts with asset managers, lawyers, et cetera. With that said, it was reported in April 2022 by the GAO that there are some 7 million U.S. households that don't have bank accounts. And they gave 3 primary reasons. Anybody know what those 3 are? Let me share it with you. People believe that they don't have enough money. People believe that the fees are too excessive or complicated, or they don't know how to access it. But number 3 is trust, the lack of trust. And oftentimes that is because people don't see people who look like them or their community. So that supports what I believe in. Now let me tell you some good news. Every one of you sitting here has met with me. On June 16th, I had the opportunity to spend more than an hour with every one of you. In addition to that, many of you, as recent as yesterday, brought staff, walked me through your changes. So I'm going to applaud you for that. And let me tell you why. But for this chairwoman pushing the envelope, maybe having subpoena power, but making sure that she was consistent. If we're going to talk about justice, if we're going to talk about democracy and fairness, then we can't get to all the other things, whether it's intelligence, whether it's cybersecurity, if you don't reflect the people that put all those dollars into your bank, buying homes, everything that they're doing comes back to what I believe in and what I stand for. You have moved the needle, and that's what I asked you to do. You sucked before that. And many still have a lot of work to do. But I am going to give you credit because I really don't believe, but for this committee, you would have been in here. I really don't believe that you would have been as serious and intentional, not just the window dressing that you've done for years. Not impressed with us saying, go hire people, and then you go hire 40 or 50 people, and none of those people report to you. None of those people have an opportunity to go into the boardroom. But now, we are moving the needle. Now, don't get real excited. We have a lot more work to do. But I do believe in saying and rewarding people who are moving the needle because that's what I asked you to do. Now, it gets much tougher as we go along. Because see, once you move the needle, I'm a clinical psychologist by trade. Once you move the needle, it means now I should be able to look at your board and see that same type of diversity. Now, Congressman Green asked you about the future, and that was really good, but I want to talk about the present. How many people have someone who would represent diversity that reports to you? We didn't have that, Congresswoman Waters, before you established this committee. How many people have taken a D&I or someone into their Board of Trustees room and did a report on D&I? We did not have that before this committee. So if you could move the needle now, part 2, which starts tomorrow, is I'm going to give you a bigger needle to move. But I want to say thank you for being here, and I'm going to tell you a bit of tidbit. We aren't just beating up on you and asking you to do these good things. You are making America better, and it means you can do much more. We have done the same thing to asset managers. Yesterday, we brought insurance, the largest insurance investment companies in the firm. They did not do so well. And so we're going to use you as a benchmark. Now we set the needle higher. And so I want to know how many people are going to make a commitment to come back, to continue to do this, and to continue to move that needle. Let the record show, Mr. Green, they all raised their hands, and I'm going to hold them accountable. Thank you, and I yield back.
Thank you very much. The gentleman from West Virginia, Mr. Mooney, is now recognized for 5 minutes.
Thank you, Madam Chair. Despite its initial resistance, leftist activists successfully pressured the International Organization for Standardization and major credit card companies to adopt a new merchant category code for firearm retailers, which they say can be used to flag lawful gun purchases and target law-abiding citizens. Merchant category codes, or MCCs, are typically used to identify merchants by the goods or services they provide. West Virginia, the state I'm blessed to represent, is one of the most pro-Second Amendment states in the country. Nearly 60% of West Virginians have firearms in their homes, which is frankly why it's one of the safest states in the country, because guns actually protect and save lives, despite what the left says about it. So, Mr. Rogers, I would just say, Truist Bank services over 260,000 West Virginians. There's also been talk of using this new data to flag what they call, quote, suspicious purchases. To me, it seems like a straightforward way to target gun owners without actually helping prevent crime. In fact, the opposite is true. The more folks avail themselves of their constitutional right to the Second Amendment, the less crime you have. So my question is, what in your mind constitutes a, quote, suspicious transaction, and what additional information does this new code really provide for you to make that determination?
Thank you, Representative, for that question. As we discussed earlier, this is a developing area at this particular time. So our positions will follow the rules that are part of the system. But as today, we'll also follow the law and protect the rights of our consumers in terms of reporting. So I can't speak to exactly what will be required in terms of reporting, but that won't be something that we'll do on a voluntary basis.
Okay, thank you for that response. A follow-up question. My constituents now may consider purchasing firearms with cash instead of a credit card out of fear that the federal government, of what the federal government might do with their data. So who decides which merchants fall under a merchant category code? And does Truist Bank plan to go back and recode businesses and past purchases that may now most closely fall under the new merchant category code?
Representative, we don't control the merchant codes, so that's not actually a decision that Truist makes.
Okay. Well, great. Well, I just, in closing, I just want to say never before have we seen an administration weaponize financial regulators and pressure lenders to push its agenda like we've seen with the Biden administration. I fear this is one step closer to a backdoor gun registry. Banks and corporations must resist this political pressure. The best thing we can do to help our constituents and all Americans is competition. Free market competition between your banks, between small banks. That's the way you get better service for all. More regulation is, we have to make a choice in this country. My mother fled a communist country. She left Cuba when she was 19 years old. And you have a choice between this country, some are pushing socialism. And what socialist countries do, like Russia, is they invade other countries because their economy is a total disaster, because socialism does not work. So they go try to gobble up other countries. We have to make a basic choice between freedom and free markets and capitalism in this country or socialism. There are those pushing socialism constantly. It has failed everywhere it's been tried. So I do applaud, I think our role as Americans should be to push free markets, reject socialism, reject, frankly, government control of people, let people be free to make their own choices, don't target them. So thank you for your participation today, and I yield back.
The gentleman from Florida, Mr. Lawson, is now recognized for 5 minutes. Mr. Lawson, you're muted. Please unmute.
Madam Chair, can you hear me? Madam Chair, can you hear me?
Yes, we
Madam
can
Chair,
hear you. Yes,
hear
we
me?
can hear you. Yes.
Okay, thank you very much, Madam Chair, and I would like to Again, as everyone else, welcome all the individuals to our committee today. And my first question is to the whole panel. For the U.S. to be strong economically and to compete globally, we need strong U.S. U.S. financial system. When you compare U.S. banks to the rest of the world using international financial reporting standards, the largest 4 banks are all Chinese, and they are working around the globe to expand their strength and influence. What are some of the most significant challenges that U.S. banks face when trying to compete with banks around the globe? And this is to the whole panel.
Mr. Lawson, are you addressing that to any one of our witnesses?
I'll just say to the whole panel.
Why don't I start, Madam Chairwoman? As we said earlier, Mr. Diamond said earlier, the near-term competitiveness of the Chinese banking system is an issue, but the longer-term competitiveness is the real issue. These institutions are the top 4 in the world. They leave aside the economic issues in the country of China right now. They've made substantial amounts of money, and they are developing the techniques to compete on a worldwide basis to support, in particular, the multinational client base of the world outside the country of China. So I think it is something to be concerned about. And, you know, frankly, they can operate in the U.S. under the current rule set, and they could acquire many of us without much problem in terms of financial resources to do it.
Is anyone else would like to comment on that before I go to another question?
I would.
Yeah, go ahead.
Jane Fraser from Citi. I thank you very much for the question, Congressman. I would add in that when our banks operate abroad, many of us are supporting American multinationals abroad and their competitiveness. And scale matters in supporting these companies, and they also result in jobs in America and the support of the economy here. And so for that not to be operating on American rails could be problematic in terms of safety, security, cyber, privacy, and many of the themes that we've been discussing at today's hearings. It's better on American rails than on others.
Okay, thank you very much. And I have another question for the panel. You know, in 2021, a report from Freddie Mac demonstrated that homes in Black and Hispanic neighborhoods are much more likely to receive appraisal value below the ones that are in majority white neighborhoods. After taking into account the difference in home and neighborhood quality, racial biases lead to the valuation of homes in majority Black neighborhood at 23% less than those in other neighborhoods with fewer or no Black residents. Are any of your banks using alternative traditional appraisals like automated valuation models as a means of reducing the prevalence of impact of appraisal bias? And I want to say this to you. In a lot of the, and I'll just use for an example, in the area in Florida, break it down a little bit to the area, and I need to hurry up because if I run out, because I want to have y'all break it down, and let's say in the area of Tallahassee in Florida. Many of the young graduates who are coming out of school seems to go into Black neighborhoods to try to rebuild them. But they're having problem because the banks don't want to finance those mortgages and say that, why don't you go someplace else, so to speak, but that's how you can improve the community. But I just want to know, are you all using any alternative evaluation model for appraisals so that the young ones coming out, and I'm just cut it right there, will be able to get mortgage finance?
Thank you, Congressman. I'll speak to that very quickly. We use alternative models, alternative sources of payment where we see, past rental payments and so forth to do that. It's easier to do when we own the mortgage or the home equity, in the case may be, than it is to do inside of the Fannie, Freddie, or Ginnie Mae programs. The government programs don't support that.
Okay, with that, Madam Chair, I yield back. I have a lot more questions, but I'll just submit them.
Thank you very much. The gentleman from Ohio, Mr. Davidson, is now recognized for 5 minutes.
Thank you, Madam Chairwoman. Thanks to our witnesses and to my colleagues. Appreciate having this hearing. A few years ago, we saw a few large banks adopt a policy of refusing cash deposits. Is accepting cash deposits a liability? And if so, is it more of a market risk or a regulatory bank secrecy risk? Anyone? Mr. Diamond?
You're reminding me of something from years ago. I do believe it was a regulatory risk that made us very cautious about accepting cash deposits, particularly interstate.
Mm-hmm. Mr. Scharf?
I don't have anything to add.
So the regulators have intimidated the banks, the mega banks, as my chairwoman likes to refer to you all, to the point where no one even speak about taking cash. Are permissionless payments a risk to this financial system? Permissionless, like cash, like I can give a person cash, whether it's cash or some sort of electronic payment. Is a permissionless peer-to-peer transaction some sort of threat to the financial system?
No.
No? Okay, that's good to hear. I was getting a little nervous. It's hard because a lot of people still deal in cash. When we talk about people that don't necessarily use your bank or some of the barriers to people using the financial sector at any size or scale, they're still transacting in the cash economy. And as people become more nervous about, frankly, whether it's government or just surveillance capitalism, the idea that everybody needs to know everything about every transaction and everyone else. We've got a couple colleagues who are really passionate about digital identity. You basically get a background check somebody to even talk to them. People are kind of opting out of that, and they're choosing cash. I think that's a big factor in the crypto space. Just by show of hands, does your bank custody any crypto assets for any level of client? Not much. So not much change there. There are a lot of regulatory challenges that have made that hard as well. And certainly we've worked, some of us have for years to remedy that. Our financial markets, we're home to about 5% of the world's population, almost 25% of the world's GDP, but roughly 50% of the world's invested capital in capital markets. Unfortunately, in the crypto space, roughly 70% of the liquidity is offshore. And I think that's a burden for this body here in Congress to provide regulatory clarity in those things. And I just, note the, I guess, hesitancy for titans of industry, people in the financial sector, literally atop the sector, to address some of these issues. And I think it's a concern when we look at regulators, how the power the regulators have over the sector. And frankly, one that I think was a win of sorts was not seeing Omarova confirmed for the Office of Comptroller of Currency. No one made President Biden nominate her or Senator Sherrod Brown give her high praise and walk her around the Senate and try to get her confirmed. But she's someone who described herself as radical and held fundamentally different views on the banking industry, going so far as to suggest that the Federal Reserve or even the Postal Service should be retail banking outlets. Mr. Diamond, do folks that have no industry experience and only academic experience have a hard time understanding soundness and risk in the private sector?
I would love to see the Federal Reserve be in the retail banking business and running call centers and operating centers and ATMs and branches and hiring and all that kind of stuff. And I would love to see more people who are not academics and lawyers and economists in a lot of jobs in Washington, D.C. I think that, there's a great quote, in theory, practice and theory are the same. In practice, they're not. I think the country would benefit greatly from something like that.
Yeah, I've been concerned because I think there was a study that showed the median years of private sector experience in the Biden administration is 0. So hopefully the next few years changes that. Ms. Fraser, I have just a few moments left. Your bank does a lot with sanctions, as do all of yours. But you look at the international aspects of it, the Office of Foreign Asset Controls.
I need to know how to pronounce Monahan. Sorry.
Yeah, no, I'm so sorry.
That's, someone please mute. When you look at the opportunity to improve that, the way that the system is done causes a little bit of collateral damage for domestic companies. Do you have any ideas on how we could reform that? And if you can't finish your answer, could you please send something to our office about your experience?
I'd be delighted to. It will involve international collaboration.
Thank you.
Wish we had time for more corrections of information that's being given about the banks and cash. However, we must move on. The gentlewoman from North Carolina, Mrs. William Adams, is now recognized for 5 minutes.
Thank you, Madam Chair, and thank you for hosting today's hearing. To our witnesses, thank you. I am particularly glad to see some folks from back home, Charlie Shaw from Wells and Bill Rogers from Truist, and Brian Monahan from Bank of America. Thank you all for being here, and everyone else as well. But I do want to get right to it, and I'd like to ask you to keep your remarks around 30 seconds so we can hear from everyone. And this question is to each of the witnesses. As you all may know, I am founder and co-chair of the bipartisan HBCU caucus, and through the caucus and through the CBC, we've helped secure historic wins for historically Black colleges and universities. So I'm grateful that several of you here today have taken our partnership challenge. Some of you, like Truist, Wells Fargo, have endorsed our signature legislation, the Ignite HBCU Excellence Act. Thank you for doing that. This, by the way, is HBCU Week, and the White House initiative is pushing that as well. But my question is, I want to know directly, and please be detailed as much as you can, what is your long-term plan to engage with, to support, and to recruit from HBCUs, and how are you evaluating the effectiveness of your external recruiting efforts and internal pipeline programs? So, Mr. Sharp, let's start with you.
Sure. Thank you, Congresswoman, and thank you for your leadership in this area. It's extraordinarily important work, and we're proud to be a part of a lot of your leadership efforts. The HBCUs for us are just an incredibly important relationship, and it's multifold. From the things that we do to support the HBCUs to the things that we get out of the HBCUs, including just the broad-based talent in locations across the country. And we've just had outstanding experience with some of just our incredibly senior folks across the company who are products of the HBCU system. And so ultimately what we will look at is the success factor that we have in keeping the folks that we bring on from the HBCUs, and ultimately the level of seniority and the scope of the roles that they carry inside our company.
Okay, let me move on. Mr. Rogers, sir, and we want to really keep it to 30 seconds if we can, okay?
Great, again.
Thank you.
Again, thank you for your great leadership in this area as well. And similarly, we're investing, and we've invested as much as $20 million recently in HBCUs in terms of direct investment, but also in the important work that we do in hiring HBCU graduates, and we committed to increase our hiring of HBCU graduates, and then working on using the resources that we have in our company. And as you have participated in our Leadership Institute, using it to help educate and provide leadership training in the HBCU community, and then things like the Tech Summit, which we've supported together. So using our own resources and working in partnership with the HBCUs, I think, is what's important.
Mr. Diamond, are you?
Yeah, I'm sorry, I didn't hear you. I've been going to HBCUs for 30 years. We hire 100 kids a year now. We just recruited 4. We now recruited 20. We help finance them. We help grow them, and we hire a lot of their kids. I would tell anyone, if you want, the talent is unbelievable. I've been to many of them. I've been to 6 or 7 now. Extraordinary talent, and my advice to anyone who's looking for, young Black kids who want to be successful, go to an HBCU if you think you can't find any.
Well, that's where you can find them. Mr. Frazier?
Thank you very much for the question. I think, like our other colleagues around the table or on the panel today, we're very proud to be working with the HBCUs. Our CFO at Citi is the vice chair at Howard and puts tremendous passion into making sure that we have a broad set of programs to bring in and recruit and grow and develop the talent that we bring in from the HBCUs. And I think similar to what you've heard today, it's wonderful talent. And we're proud to give opportunities in our company to the benefit of the company as much as the individuals.
Thank you, ma'am. Mr. Monahan, we've got just a few more seconds.
Sure. I think along with the hiring that we have continued to increase across time, along with the fiscal support of contributions to the HBCUs, endowments and budgets for helping build them out, which is $25 million over the last few years. On top of that, the other thing we've done is created an entrepreneurial center in Atlanta between the two HBCUs, Spelman and Morehouse, which is get them to work together is kind of interesting, but we were able to create an entrepreneurial center that is going to be quite successful.
I apologize, I'm out of time, and we'll be watching. Madam Chair, I yield back.
Thank you so very much for all of the work you do with the HBCUs, Ms. Adams. We appreciate that. And then proof of the pudding is in the eating. Thank you. The gentleman from Ohio, Mr. Gonzalez, is now recognized for 5 minutes.
Thank you, Madam Chair. I'm going to do a little macro, micro. Mr. Diamond, I'm going to ask you some macro questions. Mr. Moynihan, more on the micro side. Mr. Diamond, you've been outspoken about the state of the economy, global economy, and some of your concerns. I'm going to define a soft landing, just for the purposes of this, as a mild recession with limited financial stability risks. A hard landing is a prolonged recession, 2+ quarters, with heightened stability risks. So keep that in mind. From a policy standpoint, what are you most concerned about, or what do you believe needs to happen to avoid the hard landing scenario?
I think the sooner that the Federal Reserve gets the hand around inflation, so we avoid stagflation, that is the worst outcome, is inflation with no growth and unemployment, and that hurts the most people and the most businesses, et cetera. And second is to make sure we have a secure energy policy so that oil prices don't skyrocket. Energy is precarious. We know if we see it at 150, it'll cause a global recession.
How confident are you in the Fed's ability to do that?
I'm keeping my fingers crossed.
Yeah, me too. In the event of a hard landing, where do you believe the economy is most vulnerable from a financial stability standpoint?
You know, the consumer going into a recession is actually in rather good shape, particularly compared to 2008 and 2009, and business is in rather good shape. I think if you have a hard landing, you'll see a fairly traditional effect on financial stability. I don't think that's the issue. I think the real issue is global stability relating to Ukraine and China and kind of more forward-looking. The financial industry here can easily handle a hard landing.
So I agree with you on, and this is a comment now for everybody, I guess. I agree with you on the China piece for sure. I would encourage your banks to be a lot more thoughtful about the role that you all play in facilitating the Chinese economy. They rely on U.S. capital markets to grow their economy. We know that they are no friend of ours. And when you talk about global stability, it's Russia and China that are proposing the greatest threats by far. And I don't believe it's even close. Mr. Moynihan, I want to switch to you. Get back to the consumer. So your retail customers, how do you feel they are today from a health standpoint? And then in the event of a hard landing, what are you most concerned about at sort of the retail level?
Sure. So if you look at where the consumer stands today, they have more money in their accounts, as my colleague said earlier. They have borrowing capacity left. The unemployment rate's very low. Their wages are rising. Working against them are inflation price increases that will eat up part of that increase, and also unemployment. In the end of the day, we haven't seen unemployment move. So the question is, can the Fed tighten strongly enough to choke off inflation without creating such high levels of unemployment? And you know, that's the discussion you're having, the probability of a hard landing and soft landing. And the view is we all hope that the balance can be restored to the system, but it needs to be restored because right now it's not in a proper balance after the last couple of years and the fiscal stimulus and monetary stimulus and all those things. The consumer is spending 10% more in September than they did last September, and they have multiples of money in their accounts now than pre-pandemic, and they're employed and they're earning more. So right now it's okay. The question is what happens to them, and that's always going to come down to if they're working, they'll be fine. In the end of the day, no matter what kind of loan they have, car, home, credit card, you pick it. If they're working, they're fine. And I think that's the issue is to actually get labor markets to be less tight. You're going to have to work on it. The Fed knows that the unemployment's probably going to rise. The question is, can they guide it to the right place and not have it go too far?
Yeah, and that's the disaster scenario, right? That's definitionally the hard landing. The only tool the Fed has right now is to destroy demand, which would drive inflation up, or I'm sorry, unemployment up, and put the consumer at enormous risk. Mr. Diamond, back to you for one final macro question. Fed has a dual mandate, as you know, maximum employment, stable prices. Do you have an opinion on whether the dual mandate is appropriate, or would you consider moving us to simply stable prices?
I would say it's appropriate, but it should be monitored.
Thank you. With that, I yield back.
Thank you very much. At this time, we will take a brief recess to allow
Madam
members
Chair,
to vote. Yes.
Green from Texas, unanimous consent request.
Without objection, such is the order.
Thank you. I have a special purchase credit program question that I'd like to submit to all of the members of the panel.
Without objection.
Thank you.
Thank you. We will take a brief recess to allow members to vote on the House floor. We will resume immediately following votes. And let me just say to all of the witnesses, I appreciate your patience with the work that we're doing today. You may want to take this as a time to grab some lunch. The committee will stand in recess. Thank you.